Hedging for inflation. How to hedge against currency devaluation, hyperinflation, protect your financial freedom, while there's still time. Published by Michael Roth, copyright 2022, all rights reserved. Blogs it at buyandSellGoldBullion.com. Disclaimer. This audiobook is not intended to give investment advice. Rather, the intent is to discuss current economic realities and the various options and factors to consider. You should always do your due diligence prior to investing. Seek advice from a competent professional as appropriate for your particular needs. Table of Contents. Hedging for inflation. Table of Contents. Introduction. Chapter 1, Historic examples of hyperinflation. Chapter 2, Petrodollar and gold prices. Demise of the petrodollar. Chapter 3, Replacing fiat currency with alternative currencies. Chapter 4, Evolution of money. Chapter 5, Different ways of buying and owning gold. Buying physical gold. Buying gold and silver coins. Buying gold silver bullion bars. Buying gold silver coins versus buying bars. Risk of gold confiscation. Allocated gold account. Gold mining shares, funds and derivatives. Gold exchange traded funds. Gold silver closed-end funds. Gold mining shares. Gold certificates. Gold futures. Chapter 6, Gold silver storage and transport. The main players in storing and shipping precious metals. Chapter 7, I.R.A. Savings plans and alt currencies. IRA, individual retirement account, precious metals allowed for IRAs. Dealer, custodian, storage facility for gold IRA. How is a 403b different from a 401k? What is a TSP plan? Cryptocurrencies in IRA account. Chapter 8, Bitcoin and cryptocurrencies. Why cryptocurrencies make good money. What is the blockchain? Easy payment using cryptos. Asia's new Bitcoin ATM crypto exchanges. What are privacy coins and why you care? How to buy gold with cryptocurrencies. Chapter 9, Personal finance and investing tips. When to enter the precious metals market. The safest ways to offshore and store wealth. Why you should invest. What is your investment style? Stabilize your current situation before investing. Avoid impulse purchases. Use money wisely to save money. Types of investments. How much money do you have to invest? Decide where to invest. Investment strategy. Investment mistakes you should avoid. Determine risk tolerance. 7 things you need to know before investing. Investment fundamentals. What are your investment goals? Chapter 10, Estate and retirement planning. Investing for retirement. 5 benefits of long-term investing strategies. 7 common mistakes with estate planning. Long-term future investments. Chapter 11, Refinancing. Is it time for a refinance? Is it always worth refinancing? Refinancing for debt consolidation. Chapter 12, Real estate investing. 5 tricks to make it big with real estate investing. 4 steps to success in real estate investing. 5 things you should know before buying a property. 5 tips for buying a house. 5 basic rules for a successful home purchase. 5 tips to save when you sell your home. 5 tips to add value to your home when you sell your home. 5 characteristics to consider when choosing a real estate rental service. 5 key factors successful vacation rental owners often use. End notes. Introduction. Let's start off with some famous quotes. I believe that banking institutions are more dangerous to our liberties than standing armies. Thomas Jefferson. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. The issuing power should be taken from the banks and restored to the people, to whom it properly belongs. Thomas Jefferson in the debate over the recharter of the Bank Bill, 1809. History records that the money changers have used every form of abuse, intrigue, deceit, and violent means possible to maintain their control over governments by controlling money and its issuance. James Madison. Despite these warnings, Woodrow Wilson signed the 1913 Federal Reserve Act. A few years later he wrote, I am a most unhappy man. I have unwittingly ruined my country. A great industrial nation is controlled by its system of credit. Our system of credit is concentrated. The growth of the nation, therefore, and all our activities are in the hands of a few men. We have come to be one of the worst ruled, one of the most completely controlled and dominated governments in the civilized world. No longer a government by free opinion, no longer a government by conviction and the vote of the majority, but a government by the opinion and duress of a small group of dominant men. Woodrow Wilson quote about the Federal Reserve System that he was manipulated or bribed to allow its creation. None are so hopelessly enslaved as those who falsely believe they are free. The truth has been kept from the depth of their minds by masters who rule them with lies. They feed them on falsehoods till wrong looks like right in their eyes. Johann Wolfgang von Goethe. And now we have Klaus Schwab, who is founder and executive chairman of the World Economic Forum and author of the book, COVID-19, The Great Reset. His famous quote is, "You will own nothing and be happy." You see, it's important for us to know something about where we are and how we got here, before we can make informed choices on how to protect ourselves and survive these crazy times in which we now find ourselves. There are people and organizations in high places that have plans for us, even though the TV fake news will never tell you what's really going on. The current administration is trying to blame President Putin for the rising inflation. But the facts are that inflation had already started, before the Russia-Ukraine crisis, as is depicted in the images below. June 2022. There's an elephant in the room that they don't want us to know about. The reserve banks and governments have created and borrowed so much that it is debasing national fiat paper currencies that is backed by nothing but debt and promises. It's not even backed by oil anymore, more on petrodollar below. And all they're doing is printing and printing and printing, which means it's actually backed by all the debt that they created. What's really happening now, because they're going to see the currency completely start to fall apart, it's going to destroy the economy. They think they're going to bring us into the Great Reset. But their narrative from the very beginning hasn't worked. Their plan has not worked. Yes, they have a plan of bringing us into the Great Reset, a plan bringing us into the Green New Deal. But everything that they've tried so far has completely failed. People see the truth and they see something that they do not want. Look what happened out in Canada when the central bankers tipped their hand and they showed everyone, look at the power that we have. If you decide to protest, we're just going to freeze your accounts. You will not be able to use your own money without a trial, without charges, without anything. They even went after those who donated to the truckers. Once the people saw this, the people saw the truth that people understand what they're trying to do here. And as every day passes, more and more people see this, and as the entire system starts to implode, starts to fall apart, and it becomes much more difficult for people. The people need to become aware of this, because we've been brought up in a time since 1913 where the private Western central banks slithered their way in. They took control of the system and they continually took more and more control. As time went on in the 40s after World War II, the central bankers took even more control, becoming the reserve currency of the world. 1971. $35 per ounce of gold. If gold is real money, and it's now valued over $1,900, what does that say for the actual value of the fiat paper banknotes that they pass off as money? President Nixon authorized off the gold standard. They took even more control and people thought this was fantastic, because all of a sudden the wages doubled. Everything went up. Those people that had mortgages, people thought this is great, our mortgage didn't change, but our salaries, they doubled. Now, I have a lot more money to pay and I could live very comfortably. This was part of the drug. Then fast forward to 2000 and 2009. They took complete control and brought us into their illusionary world. And here we are today, where their system cannot go any further. This is not 1971. Remember, back then we came off the gold standard. Suddenly people saw inflation. They didn't understand what it was. Now, people are starting to see it all, since we are at the end of the system right now and we're seeing inflation. There is no drug, like in 1971, actually, it's having the opposite effect. Now, people are seeing the true nature of the central bank system, and as it continually crashes, people are going to recognize that this system does not benefit the people. And since it doesn't benefit the people, this is when change is going to happen. We are going through some pain because we're moving from their illusionary system into a new system. On the other side, people are going to see a world that they have never seen before, an economy that they've never seen before. An economy where we don't have to pay income tax, and an economy where we don't have to borrow the currency and pay it back. An economy where people control the creation of their currency just like the founding fathers intended. An economy where the currency doesn't lose its value. People are going to be shocked on how a real economy functions, and they're going to start to realize that a centralized money system enslaves the people. A people's economy keeps people free. Many don't realize that inflation is not just rising prices. It's actually the devaluation of the currency. An ounce of gold, back in 1913, was worth about $35. Today, an ounce of gold is about $1,977 and expected to keep rising against paper currencies. Hard assets like precious metals, other commodities, including oil, have real value. It just requires more and more of the fiat, paper currency to pay for the things we need or want. So the questions we are focused on in this book is how to protect ourselves from devaluating currency. Typically, when investors and economists speak of asset classes, these assets are all denominated in dollars of other national currencies. But what's the value of your stocks or bonds rising, if the underlying currency is devaluing? So now we're talking about alternative currencies. Different means to store your wealth, where it is protected from devaluation of the national currencies and overreaching governments who want to control our every movement. CBDC, central bank digital currency. Think about what we saw in Canada. We saw the central bankers, the deep state players, freeze people's accounts without charging them, without a crime, without telling them, hey, this is what you did. They just decided to do it. Think about what they want to do with the central bank digital currency, CBDC. Now look at what they're doing out in Canada. Was this a test case? Maybe, but now people can see the truth of the matter, and what's very interesting is that the central bank, they've come out and they said that yes, the central bank digital currency will be able to control the population of the world. Think about that for a second. You see, controlling currency, controlling people's lives is much more effective than actually having a standing army and destroying countries, buildings, destroying people's lives through death. This is the China model. Having a currency where you can decide who gets what is much more powerful than anything else. And this is what the central bankers, the deep state WEF, have in store for us. This is what they use, and they have been using from the very beginning. This is why the private Western central bank came into existence. They knew if we can put people into our system, enslave them into our currency, have them work harder and harder, have the currency devalue, make them pay taxes, that could control the populations. They can control countries, we can blackmail leaders, we can use the fake currency for all of this. And if we take this a step further as technology progresses and we use a central bank digital currency CBDC, we don't even have to do it. They'll be the ones throwing switches. They can have an algorithm decide. What did you just say on a social media post? Well, you know what, you can't purchase food right now until you change your ways. This is exactly what they want to do. Chapter 1, Historic Examples of Hyperinflation. Weimar Republic of Germany. Above left, children play with stacks of hyperinflated paper money, and on the right, a man carries his cash around on a cart. Prices ran out of control, e.g. a loaf of bread, which cost 250 marks in January 1923, had risen to 200,000 million marks in November 1923. The currency had become essentially worthless. By late 1923, the Weimar Republic was issuing 2 trillion mark banknotes and postage stamps with a face value of 50 billion mark. The highest value banknote issued by the Reichsbank had a face value of 100 trillion mark, 100 trillion, 100 million. At the height of the inflation, one United States dollar was worth 4 trillion German marks. It is believed that one of the reasons that Hitler was able to come to power was due to the hyperinflation and his promise to give the people a better life. Hyperinflation had ruined the middle class. The poor lost most of the little they had. The rich lost a lot, but being rich, they were able to fare better than the average person and survived. The middle class did not have reserves the rich had. They had led comfortable lives before the hyperinflation hit, but after, many of these middle-class lives were now ruined by hyperinflation, and they blamed the government. Zimbabwe from about 2000 to 2008. Becoming a dictator is not easy. On the one hand, there are many others around you who would like to take over your position. So you always worry about keeping power. Knowing who are the political rivals and who are allies is a constant challenge. Plus, there is the question of how to give certain people some power in order to govern, but not risk losing power to them, at the same time. It's a constant balancing act to keep power and avoid a rebellion. Robert Mugabe, president of Zimbabwe, had these problems around 2000. He needed money to bribe his enemies and reward his peers. Unfortunately, it was taxation. Almost everything was taxed, and his policies scared investors. The economy did not go well. And his people were unemployed and hungry. So where do you get the money from? Well, one of the advantages of running a country is that you get your money machine, the printing press. So you can easily print more money when needed. This is what Mugabe did. But newly printed money did not increase productivity. There was no new investment in Zimbabwe's economy. As a result, the economy could no longer produce raw materials. In fact, you had more paper money competing for the same products. This meant that the purchasing power of the Zimbabwe dollar decreased. People needed more Zimbabwe dollars to buy the same as it previously did. In other words, when the market starts flooding with freshly printed money, prices began to rise. Prices began to rise by around 50% per year. This was just the beginning. As prices rose, the government had to print more money. It was taking more and more money, just to buy the same items that could previously have been bought for a fraction of the costs, so it all got out of hand. The faster the price goes up, the more money the government prints. The price went up as fast as possible. It was like a feedback loop. The more prices went up, the more money they needed to keep printing. Prices increased 100% annually until 2001. It was 200% per year until 2002. By 2003, inflation was up to 600%. Until 2006, prices have risen by over 1,000% every year. It cost 417 Zimbabwean dollars to buy toilet paper. No, it costs $417 per sheet, not per roll. Money was immediately devalued. The money you had in the morning, by evening was almost useless. So people tried to get rid of the currency as soon as they receive it. Zimbabweans had become millionaires. Unfortunately, 1 million Zimbabwean dollars, if you were lucky, you could buy a chicken. However, the government continued to print money. They printed in higher denominations, $1 million bills, $100 million, $10 billion, $100 billion in bills. By 2008, prices began to rise by thousands of percent every month. And the government started printing $100 trillion bills. On top of this feedback loop, prices had risen at an astronomical rate. For $1 a month, you get 7.6 billion%. It's not only Zimbabwean dollars that can be devalued by a government trying to print its way out of inflation. By the end of 2008, Zimbabwean dollars are practically gone, and Mugabe had no choice. He helped legalize foreign exchange transactions, and Zimbabwe's hyperinflation finally ended. There are other extreme examples of hyperinflation: Yugoslavia 1994, China 1949, and Germany in 1923. Chapter 2: Petrodollar and gold prices. How did the dollar become the world reserve currency to begin with? Enjoying absolute power at international levels and regarded as the basics for sales, pricing and conversion. Many do not understand why and how this is, and few are concerned enough to find out. In the early 1900s, the United States did not have the power they now pose. But due to their power on the financial front and their determination to keep the dollar flying high at any cost, they have done the unthinkable. Before the era of the petrodollar, the natural resource that was most abounding was gold, and the value was held very high. It was not until in 1945, after the Second World War, there was an agreement that the dollar should be used as the world reserve currency. This meant that all international commodities were to be priced and treated in dollars. Inevitably, this gave the United States a very unique and powerful financial advantage in the world economy. Where the US paid for commodities in dollars, other nations first had to convert their currency to dollars and then purchase the same commodities. This gives the US an advantage and lower costs for oil and other commodities. Foreign reserves that were kept in dollars, it was agreed that it will be made available and exchangeable for gold, whenever any nation or depositor wanted it. And the United States would not have the power to print dollars to saturate the market and dissolve the value of gold. This was not upheld, as the United States did not allow any supervisions of the printing press. It was made very clear during the Vietnam War that the United States was spending a lot more money than the value of the gold that was supposed to be backing it. This led to many countries asking for their gold back. This would have dropped the value of the dollar and brought it back in line with the value of gold that was supposed to be backing it. But the United States wasn't ready to give up that power and allow their currency to diminish. President Richard Nixon took action in 1971 to end dollar convertibility to gold and implement wage/price controls. These were intended to address the international dilemma of a looming runs on gold, and the problem of inflation in the U.S. The new economic policy marked the beginning of the end of the Bretton Woods international monetary system and temporarily halted inflation. Whereas, previously the Bretton Woods policy had required that the dollar would be tied to the price of gold. This began the era of seemingly free money, as the Federal Reserve and other central banks have been printing with wild abandon, devaluing fiat, paper money, globally. This has resulted in a trend of countries repatriating their gold that had previously been stored in other nations. Wikipedia states, gold repatriation refers to plans of various governments to bring home their gold stored outside the home country. Many countries use foreign vaults for safekeeping of part of their gold reserves, and there is a growing tendency not to trust the foreign custodian. In past, nations from across the globe have stored their gold at the Federal Reserve Bank of New York, FRBNY, for numerous reasons. During World War II, Germany confiscated as much gold as they could from nations they occupied. Other vulnerable nations anticipated by shipping their gold to the U.S. After World War II, there was the threat of the USSR to seize sovereign gold reserves under the Bretton Woods system, 1944 to 1971. It was agreed the US dollar was the world reserve currency, backed by gold. It was thus convenient to store gold in New York for trade settlements. Additionally, dollars that were converted into gold were credited to FRBNY foreign gold accounts. After the Bretton Woods system, when gold was officially removed from the monetary system, gold was often sold or leased by central banks, facilitated by their accounts at FRBNY. In the aftermath of the financial meltdown in 2008, central banks again realized the importance of gold as an anchor in the monetary system. European central banks stopped selling gold, Asian and South American central banks increased official purchases, and central banks from all continents began to worry if storing gold abroad was wise when the global financial crisis evolved. There are rumors that US has sold a portion of this gold to underpin the US dollar hegemony in recent decades. Edmund Moy, former director of the United States Mint, Fort Knox, quoted on June 13, 2014, "Finally, more countries are repatriating their gold. For them, an audit is not enough. They would like their gold back." Azerbaijan, Ecuador, Iran, Libya, Mexico, Romania and Venezuela is a short list of countries that have requests into their custodians to transfer some or all their gold back to their countries. In 1973, Nixon and his Secretary of State, Henry Kissinger, concocted yet another system to let it continue spending money. They asked King Faisal of Saudi Arabia to accept only US dollars as payment for oil, and that the Saudis would then buy US Treasury bonds, notes and bills with their massive profits. In return, the United States pledged to protect Saudi Arabian oil fields from seizure by any enemy of the kingdom. It wasn't long before the offer went round to all other major oil-producing states, and before 1975, all the members of OPEC, Organization of Petroleum Exporting Countries, had also agreed. So other nations were required to first exchange their currency for dollars and then purchase oil in dollars, which effectively raised the price to the rest of the world, while the United States was benefiting from artificially lower prices. And this is the motivation to retain the petrodollar. When this era ends, citizens of the US will be paying more for oil than they are used to. Then the puppet masters will be exposed, as the surest way to get the attention of a population is through their wallets. The United States has gone to great lengths to see that no other currency will outwit theirs, and to maintain this, havoc has been wreaked upon other nations. Many question why many countries are experiencing the brute force of the United States military? Could it be that those pulling the strings and making policy are the ones benefiting by the unfair advantage that the United States has enjoyed, as a result of the petrodollar arrangement? Let's look at the map and connect the dots for ourselves. In 2002, it was known that Iraq had started selling their oil to other parts of the world in euros, which was a direct and conflicting attack on the dollar's hegemony. The United States knew that this would result in other oil-producing nations choosing to sell their oil in euros, which would seriously impact the dollar and give rise to the euro. This would not be tolerated by the United States. And since they spend more on military than the rest of the world combined, the military has been used to defend the petrodollar. The world was sold on Iraq having weapons of mass destruction, and a coalition was formed to ultimately gain control of Iraqi oil fields and reverse policy on selling oil in euro. Declassified emails reveal that NATO killed Gaddafi. Washington, D.C., in spite of the French-led UN Security Council Resolution 1973 creating a no-fly zone over Libya with the express intent of protecting civilians, one of the over 3,000 new Hillary Clinton emails released by the State Department on New Year's Eve contained damning evidence of Western nations using NATO as a tool to topple Libyan leader Muammar al-Gaddafi. The NATO overthrow was not for the protection of the people, but instead it was to thwart Gaddafi's attempt to create a gold-backed African currency to compete with the Western central banking monopoly. The Foreign Policy Journal reports. The email identifies French President Nicolas Sarkozy as leading the attack on Libya with 5 specific purposes in mind: to obtain Libyan oil, ensure French influence in the region, increase Sarkozy's reputation domestically, assert French military power, and to prevent Gaddafi's influence in what is considered Francophone Africa. Most astounding is the lengthy section delineating the huge threat that Gaddafi's gold and silver reserves, estimated at 143 tons of gold, and a similar amount in silver, pose to the French franc, CFA, circulating as a prime African currency. Demise of the petrodollar. At this time, several nations are making efforts to reduce their reliance on the dollar as the primary currency for settling trade. Though the situation seems bleak for the dollar, we are wise not to hide our head in the sand, but rather to take evasive action for the possibility or inevitability that the day of reckoning may be coming to roost, sooner than later. And what will this mean to the price of gold? When the dollar is no longer propped up through agreements, all those dollars that have been printed by the Fed will have to be revalued to their value against gold or other commodities. And holders of dollars and some other currencies will be shocked to one day see their paper money worth about what it's printed on. Truly, the era of the petrodollar is approaching extinction. But no matter how long or short the process will take, gold will seek its true market value against all currencies. In this Russia Today YouTube video they explain why Russia, China, India, Japan, Turkey, Venezuela, and Iran have all made moves away from the dollar, de-dollarization, including reducing their holdings of US debt and increasing each of their respective gold reserves. This is concerning for the stability of the US and the global economies. Change is inevitable. And so is the rise in prices of precious metals. The question is how well are we each prepared to weather an unpredictable storm. Chapter 3, Replacing Fiat Currency with Alternative Currencies. We know from the past that eventually what's going to happen is gold is going to destroy the Fed because remember we're seeing inflation. Trump has told us that as we see more and more inflation, which means that the valuation of the currency, it's going to destroy the economy. The entire private Western central bank system has been built on an illusionary fiat system, backed by nothing. The dollar is not even backed by oil anymore. And all they're doing is printing and printing and printing, which means it's actually backed by all the debt that they created. People are starting to realize this and understand this, and this is why everyone needs to understand that you need to get out of the private Western central bank system. The private central bank system is the fiat currency. Yes, you still need fiat currency, you need it to function in their illusionary economy. But let's go back to the 1930s. Remember when they wanted everyone's gold and they said, listen, we got a great deal for you. You give us the gold and we'll give you 20 pieces of paper for $20 an ounce. Sounds like a good deal. Great. You got the paper and they got the gold. Now think about all those people that said I have no gold and they buried it in their backyard and they kept it. As soon as the government and the Federal Reserve had what they wanted, they repriced gold to $35 an ounce or so. Think about all those people that received the paper fiat currency. They just lost value right off the bat. The people that decided, you know something, I'm going to do what the central banks do, what governments around the world do. I'm going to take care of myself, I'm going to be self-sovereign and I'm going to control my wealth. Those people made out, because one minute their gold was $20 an ounce. The next minute it was $35 an ounce. And then all of a sudden people said, well wait a minute, look what just happened here, it seems the same thing is going to happen once again. As the fiat currency continually devalues, what's going to happen is precious metals and most likely Bitcoin and certain other cryptocurrencies are going to skyrocket. Are we going to see that right at this second? No, it would be too obvious. As time goes on and when it's time, yes we will see this. This is how you get out of their system. Yes, you still need to function in their system. You still need the fiat currency to do whatever you need to do, but you can take portions of it and move it aside to protect your wealth. Or more likely we will see parallel economies rise up, where you can buy and transact in gold and cryptocurrencies. Now we know that you can do this very easily with gold and silver. You can purchase the physical asset, the currency, and you can have a safe or buried in your backyard or vault stored abroad, in an allocated account in your name. Just remember where you put it and you can keep it, just let it sit there while you acquire some more. The same thing can be done with Bitcoin, but this is electronic. So I believe both of them will be needed. Actually, both of them will allow you to be out of their system. Bitcoin provides the ability for individuals to receive, save and send money in a self-sovereign fashion. Stomaching volatility is worth the level of control that no other money on the planet, except other cryptocurrencies, especially privacy coins, can provide. Every other monetary system wants to control you. Bitcoin takes the control away and hands it to you. It's pretty simple. I know I own 21 million Bitcoins. I control my keys so no one can prevent me from sending or receiving. I can verify that my Bitcoin real on my computer. More individuals will recognize this utility as time goes on. It seems that in the end, people are going to start to realize, you know something, I need to protect myself. And I think it's already started and it's been going on for quite a while. We know that the very, very wealthy have been doing this for quite a while. But the everyday person, they're starting to realize this too, and they're taking action right now to protect themselves. The central bank system, from the very beginning, all they want is control. They want to control your economic life. They've done this since 1913. Actually going back way before this with the other two private Western central banks. They always wanted to control you, and they try to control you by putting you into debt. And they continually did this across the globe. This way they can control the governments, they can control the people now. They want to take it to the next step. They want to control your daily lives. Where listen, if you don't agree with us politically, if you get out of line, we can shut you down. That's the type of control they want. And, yes, they're going to hook it to the Green New Deal and to a carbon footprint. They are going to tell you that if you use up your allotted carbon credits, you can't spend any more. Too bad for you. But for those people that want to do business outside of the private central bank, those people are starting to realize how important this is, and people are ramping up on gold and silver and Bitcoin and some other cryptocurrencies, because they know in the end, it's better to be outside of the system than in their system. If the world decides, and this is how simple it really is. Eventually, the people will reach the precipice and they will see that the paper currency is only backed by the confidence or lack of confidence in it. It doesn't have any intrinsic value. When they see what the private central bank, what the public masters are trying to do, the people can make a decision with information, a logical decision. And if everyone decides, listen, we don't really want to go into your system because you're talking about control. You're talking about watching what I do, how much I can spend, how I can live. People in this US and other countries, they want privacy, they want to be free. They don't want people telling them, you can buy that, but you just ran out of your carbon footprint. So now you can't buy anything. Or if you speak up against something on social media, we're going to shut down your spending, shut down your accounts. We saw this in Canada. It's not that far-fetched. They were already starting to do this and they backed off very quickly, because everyone started to notice, whoa, wait a minute, are you doing? You did this without a trial, without anything, without evidence. You just decided to do this. And you had banks do this. Think about this for a second. Think about what they did in Canada. And people saw this very, very clearly. Why? Because there was no chaos, there was no noise, there was no cover story, there was no disaster. There was no destruction. They didn't have any of that. And people were able to see this so clearly, they understood exactly what was going on. And people started to panic after this. They said, well, wait a minute, this is crazy. And this is what's going to happen as we move down the path. Going back in time, if someone came up to you and said, listen, the central bank and the World Economic Forum, they want to control your spending. You're going to have a carbon footprint, and once that is reached, you won't be able to spend. If you speak out against something and you're not politically aligned with them, they will shut down your account. People would think that is absolutely crazy. They would never do that. Think of all the people that got their PayPal account shut down, because they decided to speak out. Think about all the people who got their Venmo accounts shut down. It's already started in different countries. Think about this for a second. This is just the beginning. But you needed to see it to really believe it, and you're going to see a lot more, and this is going to bring people to the precipice. The economic precipice, and it's not going to be one-sided. It's going to be the people together saying, we don't want this, and they're going to push back. And in the end, the people are going to go in a completely different direction. The people will seek out alternative currencies and privacy. When the facts and the truth come out about the central bank system and what they actually had planned and what they've been doing with all this currency printing that they've been doing for many, many years. Yes. It's not just government. The Fed is in line with the government and these individuals to continually print and print and print, and this money that they launder all over the place. They use it for specific reasons. And once we audit, once we see what they've been doing, the people are going to understand, hey, they were never working for the people. They're working for themselves. Actually, they're working against us. In the end, when the people reach the precipice, they're going to demand accountability. And once they get the accountability and they see the truth, people are going to say, we're done with this, and get rid of the central bank system. Chapter 4, Evolution of Money. Long before governments released currency like the dollar, euro, or any other modern currencies, citizens must have had something else to assist them trade with one another. How did people obtain items they needed? Before there was any type of currency, there was bartering, unless of course you were a barbarian and preferred plundering. Civilized retailers and customers exchanged products or services, but trade ended up getting cumbersome. For instance, let's say the merchant selling clothes didn't want your 47 pounds of fruits in return for a pair of pants. To make commerce just a little simpler, the buyers and the sellers in the marketplace progressively made the decision on what could be used to facilitate trade. They made the decision that something was needed to be utilized as a currency. That currency needed to be portable and broadly recognized as a unit of transaction, a store of value, along with a medium of exchange. Anything they chose as currency must be something which carried out the function of money. For thousands of years, precious metal, mainly silver and gold, filled the balance nicely. More than anything else, gold and silver has been considered to have intrinsic value that could be agreed upon by both sides of a transaction. Aristotle, 384 BC to 322 BC, reported 5 key characteristics of money: it should be sturdy, it should be portable, it should be homogeneous, and it must be easily divisible. It also has to be very difficult to counterfeit. From that we are able to add yet another factor, scarcity, to reach 6 key characteristics of what makes good money. 1. Sturdiness. 2. Portability. 3. Divisibility. 4. Scarcity. 5. Homogeneity. 6. Hard to falsify. What are the reasons that these characteristics desirable in money? Why are gold, silver considered good money? Sturdiness. Sturdiness is a straightforward concept to understand, and it's easy to determine why it ought to be thought of as a good financial attribute. Physical money, coins and notes, are simply as high quality as long as it's recognizable tender. Coins that damage easily will ultimately drop out of circulation, because traders are going to be disinclined to accept them as payment. Sturdiness in money has been rejected due to the rise of electronic payments. However, as long as we still use physical currency or physical backing of currency, it's important. Gold has incredible sturdiness. It doesn't rust, tarnish, or corrode, with no substance that can easily destroy it. Gold is also probably the most malleable metal recognized by man. A single ounce can be beaten right into a 300 square foot sheet, such as in the case of gold leaf. This malleability makes gold very easy to shape into coins, bars and multiple other things for industrial uses, such as wire or other electrical components. Physical currency must also be portable. What is currency used for? It's used as a divisible medium of exchange for paying for products or services. This would be far more difficult if you were using a herd of cattle, for example, as a way of payment. This is why societies evolved into using paper notes and coins as a way to make payments. Of course, now they have largely been replaced by just digits on a computer screen or electronic transfers, where nothing tangible is ever changing hands. That's fine, as long as you can trust whatever is supposed to be backing that system. In the case of precious metals and Bitcoin and some other cryptocurrencies, the quantity is limited. So creating more at the flip of a switch cannot result in dilution of the value of what already exists. Divisibility. This brings us to Aristotle's third requirement of divisibility. For this reason, you cannot use artwork as money. It is impossible to chop up a painting, for example, into multiple parts and still declare that added together, the various pieces, added together will be worth the same amount as the original work of art. Homogeneity. Precious metals are unlike the above example of the work of art that cannot be divided and still retain its value. Gold or silver, on the other hand, can be melted down, formed and melted down again and recombined into coins, bars or jewelry. And still, the bullion value of the metal, by weight, will still be based on the market value of bullion at that moment, multiplied by its weight. Nothing has been lost by dividing or altering the original metal. Of course, in the case of coins or sculptures made from the metal, that is a different story. The value can be infinitely greater than its bullion weight would suggest due to rarity, age, degree of wear, etc. Scarcity. Scarcity is why elements such as iron or aluminum don't make a good money. Aluminum, 82,300 parts per million, equals $0.000077/ounce or $0.0011/pound. By comparison, silver, the most typical element within the periodic table is considered precious metals, happens at a rate of just 0.075 ppm. The same figure for gold, though it's probably not the scarcest rare metal, is just 0.004 ppm. Portability. Crude oil is divisible, durable, portable and incredibly useful. So then why don't we use barrels of the black stuff as money? Because, whereas gold, which sits at number 79 in the periodic table, it has a uniform grade and fixed consistency. Whereas other commodities, such as oil, corn, wheat, soybeans along with other such goods come in several grades, making their use as money much more complicated. Gold's homogeneous character supports its use as money. And, Just like other goods, the area required to store $10,000 worth of oil is much larger and far more cumbersome than the area and ease required for storing $10,000 worth of gold, a definite storability problem. Difficult to falsify. Aristotle's last attribute of excellent money: is it difficult to falsify? This is yet another point towards gold as money. Alchemists have notoriously expounded much effort and time attempting to replicate gold, but with no success. The only method to increase the total stock of above-ground gold is as simple as mining more of it. No doubt why the Chinese are buying up so many mines around the world. There are various sorts of tests that gold sellers may use when assessing gold items. For example, visual inspections of the product using microscopes, mass, size and sound tests, in addition to magnet tests. These tests, along with other such tests, can certainly tell fool's gold from the real thing. Many of these material qualities have brought people to summarize that so far as commodity currency is concerned, gold rules. Good as gold is more than a catchphrase, it's the real meaning of gold's performance in recent decades. Why gold makes good money? In the year of 2011, just 2,818 tons of gold were found, that is around 1.7% from the total above-ground gold stock at the end of 2010. Since 1492, the entire year of Columbus's first voyage to South America, the above-ground stock hasn't elevated by a lot more than 5%. As of 2012, the World Gold Council showed the world's total above-ground gold stock at 171,300 tons. Gold's scarcity and also the relative consistency within the increases in above-ground stock have important implications when thinking about its use as money. This is because dramatic shifts on the supply could have equally dramatic shifts in the market value, thus affecting the value to the money itself, irrespective of what the gold money is being used to purchase. A gram of gold has bought roughly the equivalent wheat since the Middle Ages, and it has maintained its buying power well when compared with various national currencies. Chapter 5: Different Ways of Buying and Owning Gold. You can find further, in-depth information and links to various options for investing in precious metals, also free guides and reports at our blogs. There are two primary techniques for enjoying gold ownership. They are buying physical gold, or by buying paper gold, or sometimes referred to as electronic gold. However, there are multiple options of how to own physical precious metals. One is to take home delivery, which is not recommended in larger amounts, because then you need to be concerned about safeguarding it in your home or wherever you're storing it. Having some silver on hand, in case it was ever needed to buy things, in the event of a Weimar Republic scenario, breadlines and the like, is a very practical idea. Another way of owning physical metals is to have your dealer assist you in arranging storage in a secure facility, such as Brinks and others discuss the gold-silver storage and transport below. You can choose your storage location, domestically or abroad. A third way of owning physical gold and silver is with an online trading platform, where you can buy and sell metals 24/7. Your gold, silver or platinum is vault stored in an allocated account on one of various countries. You can even take physical possession of your holdings, if you choose to. The other method of having an interest in precious metals may mean futures or options contracts that can provide opportunities to make huge profits resulting from gains on the value to the metal itself. Mining shares are the third category of gold investment. The following will discuss the various options highly relevant to possessing gold or silver coins, bars, ETFs, closed-end funds, certificates, and professional storage products. But what about gold futures or stock shares in gold mining companies? Is this also a viable way to take a stake in precious metals? Buying physical gold. This book concentrates on the benefits and drawbacks connected with various methods of gold investment, whether coins, bars, certificates, or professional storage. A few of these items are physical or allocated gold-silver, where you are provided with title to or direct possession of gold. Others are better referred to as paper gold items, offering a certificate or paper share of gold, rather than possession of the actual metal. Buying gold and silver coins. Prior to the beginning of the Internet era, coins and bars were among the only ways in which regular traders could own physical gold. There is still a thriving market in coins, both when it comes to well-known ones, for example, the Kruger Rands, Canadian walnut leaves, and American eagles, and also with most rare numismatic or collectible coins. Probably, the most popular coins are the following: South African Kruger Rand, French Napoleon, Canadian walnut leaf, Chinese gold panda, Vienna Philharmonic, UK gold sovereign, American gold eagle, UK Britannia, American zoysia, Australian gold nugget. Many people considering holding coins for investment purposes often favor coins created by national mints. This is mostly due to their title recognition and also the greater market liquidity, in comparison with numismatics or rare coins. Kruger rands contain a copper alloy which makes them stronger and harder to scratch, which makes them more appropriate for barter, although it reduces their gold wholesomeness slightly. You will always find individuals or companies willing to buy such coins, in contrast to collectible coins, which you might find harder to trade desperate political or economic conditions. Coins are frequently designated as legal tender in the nation by which these were minted, as is the case with Kruger rands in South Africa, although the face or legal worth of the gold coin is definitely far below those of its actual market price. Government authorities frequently apply regulations to coins minted within their jurisdiction, which are considered legal tender. So for instance within the United Kingdom, capital gains tax doesn't affect the proceeds produced from sales of gold Britannias and sovereigns. However, it applies to sales of non-British coins. Similarly, Florida's sales tax, or VAT, might not affect coins that tax authorities deem investment bullion, which often covers all the most popular coins. It might, however, affect numismatic coins. In a financial crisis, the coins that will be of most use are the types which are most recognized, which might not correspond with individual coins that attract regulations or legal tender recognition in your country of residence. And if you were ever thinking about emigrating, you'll need to be certain that traders in most of the areas you might travel to will readily accept the coins you decide to hold. This means that you may be best off with the most well-known and sturdy coins in the marketplace. There are numerous factors affecting the market value of coins, and so you would want to seek out a professional dealer with a golden track record. Buying gold silver bullion bars. Gold bars can differ in dimensions from small 1-gram ingots, sometimes known as wafers, to as much as the London Good Delivery 400 ounces bricks locked in central bank vaults all over the world. Though good delivery bars are referred to as weighing 400 ounces, they're allowed to vary in gold content weight between 350 ounces and 430 ounces. However, they should have a purity of a minimum of 99.5%. Wealthy traders may favor holding bars, given that they permit considerable amounts of gold to be saved in one location. Large bars also provide a cost edge on buying coins. This is the reason larger bars or pieces of gold usually have a cost per weight that is lower than smaller sized bars or coins. What this means is that wealthy traders can get the best possible value on a price per gram, per ounce, per kilo basis, by purchasing bars instead of coins. Commission or transaction rates on coins and bars are an essential consideration, also. Generally, the more compact gold is and also the harder it is to create, the greater the premium per gram it may be. Popular gold typically draws in rates varying from 4 to 8% above spot price. The larger the volume of purchase usually results in lower fees on a percentage basis. Throughout the 2008 financial turmoil, purchasing fees in America on some popular 1-ounce coins jumped to as much as 15%. Likewise, whenever you sell gold to brokers-dealers, you can usually expect a price reduction of 4 to 8% depending upon the amount you're selling. Security is another factor to consider when purchasing coins or bars you intend to take possession of and store in your own safe place. Clearly, there's no problem with counterfeit or performance risk so far as coins and bars are concerned, so long as you dealt with a reputable dealer going in and actually got what you bargained for. After you have bought coins, and they're your own, they're unquestionably yours, and don't constitute a liability so far as other people are concerned. This is an essential factor associated with physically having gold, that there's nobody standing between you and your gold. However, security from thievery and burglary is yet another matter. You might consider keeping your metals in a safe, but you'll then have the problem of hiding it. In the big event of your property being burgled, it is possible that your entire safe could be carried off. Purchasing a home safe contributes to your expenses of ownership, just as insurance charges do. The more you own and store, the greater these costs becomes. This is obviously a consideration for investors, who chose to store their gold silver in their own home, office or other storage location. As discussed in the section on storage, there are options for professional storage of coins, as well as bullion bars or ingots, domestically and abroad. Possibly, the greatest disadvantage to possessing gold via coins and bars is the possible lack of liquidity when in comparison with third-party storage where there is an internet platform, actively putting buyers with sellers, virtually 24 hours a day. Should you ever have to sell your gold to be able to raise cash for whatever reason, it is more time-consuming to do this through a traditional dealer than for those who have an internet-based platform. Many people may have the ability to negotiate sales of coins and bars through internet sellers, but others won't have this luxury, due to the supply of these services within their country of residence. Also, you'll have to pay delivery costs when selling back to dealers. For small coins this might not add up to much. However, for large bars the costs will increase accordingly. I recall, When I was a teenager, my dad had purchased several silver bars. His heart was in the right place, but it turned out to be a real headache, so far as storage and then physically handling the metal when it came time to sell it. You don't realize how cumbersome this can be until you've tried to physically handle a large amount of physical metals. Buying gold-silver coins versus buying bars. Pros. You actually hold the physical metal, though storage is still an option for coins. No risk of market turning against you that could cause you to lose what you've got or even more than what you originally invested. Plenty of supply to choose from: gold-silver coins, bars, ingots, etc. Cons. Security concerns with home storage, such as burglary. Insurance costs. Illiquid compared to almost instant internet-based buying and selling. Care must be taken regarding fees charged for getting in and out of positions. Risk of gold confiscation. Some nefarious coin dealers attempt to influence investors' choices by using confiscation scare tactics. They refer to President Roosevelt's 1933 executive order about gold confiscation. Consider these facts. President Roosevelt's 1933 Executive Order 6102 prohibited the private ownership of gold in America. It required U.S. citizens to hand over their gold bullion to a Federal Reserve Bank or face a $10,000 fine and/or 10 years imprisonment. The President's order listed the following exemption: gold coin and gold certificates in an amount not exceeding in the aggregate $100 belonging to any one person, roughly 5 ounces of gold, and gold coins having a recognized special value to collectors of rare and unusual coins. The rare and unusual coins clause is what many dodgy coin dealers use to convince investors that regular bullion coins are not safe and could be confiscated by the government. Under the ruse that they themselves are offering rare and unusual coins, which would be exempt from a potential future Roosevelt-style confiscation, they are then able to justify upselling the public 30% to 50% or more over the actual value of the gold content in the coin. Again, rare numismatic coins are a definite investment choice. However, one really needs to educate themselves, so that they are not taken advantage of. Moreover, in desperate economic or political times, it's almost certain that you could not receive peak market value for such coins. Nor could you trade them for goods and services in desperate times, unless you wanted to exchange them for their face value or bullion value. In political or economic upheaval, expect to receive closer to bullion value. Thus, a collector coin, which may be extremely valuable in ideal market conditions, will probably have to be greatly discounted to sell in times of uncertainty. If one is concerned about possible confiscation of government money, such as minted coins, then simply buying bullion in the form of bars of various sizes or ingots is the solution. These will remain liquid and keep up with the market value of bullion, wherever it happens to go. Even though there is low risk of losing your coins due to government regulations, it seems sensible to broaden your gold and silver holdings. A lot of companies offer storage in multiple nations. The more countries and continents you have to choose from, the better are your options to diversify your wealth, geographically. Allocated gold account. Why you want an allocated gold account? There are certain types of precious metals investment companies, who offer convenient online facilities for the purchase and storage of physical gold, sometimes known to as allocated gold or vaulted gold. The client is the owner of the gold directly, either by means of shared possession or as an individually registered bar. The gold is physically held by a specialist storage provider, in the location selected by the customer when buying the gold. This is the closest thing to physical possession of the metals by the individual investor that is obtainable without holding the physical metals themselves. When you are clearly reliant on the storage provider for security promises, your metal is not their assets when it comes to legal possession. This means that in case of their personal or corporate bankruptcy, their creditors won't have claimed in your gold. This is the reason that this form of ownership is only one step away from holding the metals yourself. The benefit over taking possession of physical gold is: A. It lets you store your metals in other areas, perhaps for political reasons. B. It avoids the risk of having such large amounts of valuable assets stored on your personal property. C. It prevents you having to purchase and house a safe or otherwise hide your metals somewhere and hope for the best. Since these companies purchase and sell metal in large quantities with respect to thousands of clients, by means of large bars, rates are low because of the volume of their business. Additionally, you can put purchase and sell orders for metal anytime you choose, online. These services are provided via a web-based customer interface. This provides an advantage over the typical investment in coins and bars for those who desire to make more frequent purchases of gold or silver. It's very easy to set up a standing order through your bank to purchase a specific amount of gold or cash amount worth of gold every month, and easier than heading down to your local gold coin shop to make a purchase. Since an account with this type of online service can be set up in minutes, and money can be transferred from your bank account within a few short days, this also provides a means of easily offshoring wealth. It allows one to gradually or quickly move whatever amount of money they choose to move abroad, out of the reach of one's own government. And for those who travel frequently or spend a lot of time away from their home, internet-based possession that may be associated with a number of accounts in various nations has advantages over other forms of ownership. This method also provides great possibilities when it comes to diversification. No one can say with any certainty exactly what the future holds for gold holders, when it comes to taxation, regulation as well as potential confiscation of gold. For that reason, it seems sensible to broaden your gold holdings. A lot of companies offer storage in more different nations. The more countries and continents you can decide from, the better you can diversify your wealth geographically. Bank gold is usually unallocated. Take care when buying gold from a bank, or in a pool account, or even from some major gold certificate providers. As you set out to buy gold, the first thing you need to know is that 95% of the world's gold businesses, especially banks, will automatically sell you the wrong type. Unallocated gold is the most common means by which gold is traded, globally. The fact that the gold owner is exposed to risk from this form of ownership is usually hidden. Usually the investor will remain unaware that they are in a compromised position, until it is too late. The commonly quoted spot price usually refers to unallocated gold, and the annual fees are slightly lower, which often lures in prospective buyers, thinking they are getting a better deal. However, when a bank sells you gold, it is almost always unallocated. You become a creditor, i.e. the bank owes you gold which you do not own. They take advantage of the fact that most investors do not know an alternative method for ownership and storage, and it seems logical that since their gold is safely in the bank that they are in a secure position. You sign a document, and according to the law, you are now a depositor of the gold into the bank. Most people now assume that their gold is completely secure, whereas had they paid slightly over spot price, they could have their gold stored in an allocated account. Banks required by regulators to hold a portion of its liabilities as certain types of liquid assets that can be turned into cash for its self-preservation, in the event of a crisis. Your gold is then used by the bank as a means of protection against a liquidity crisis. This occurs when a bank cannot meet its obligations to meet the immediate demands that occur from unexpected withdrawals made upon the bank. Since gold is money, physical gold bars are considered an excellent form of reserve for the bank, as they can be turned to cash quickly. In an unallocated account, the bank actually owns the gold and you are a creditor with a claim against the gold. The problem is that the bank has other creditors, also. From the standpoint of the regulators, your gold is considered part of the bank's liquid reserves. It's obvious to see why banks love this form of unallocated gold account. They get to use the investor's gold to prop up their own balance sheet, and the owner remains at risk, which is exactly what the investor was attempting to avoid, if he had only known. Not surprisingly, your unallocated gold would be immediately sold if the bank needed liquidity to satisfy its obligations. Since the unallocated gold is part of the bank's liquid reserves, it is required to sell gold on short notice to cover its creditors. All of the creditors, including you, would receive a proportional share of the proceeds from sale of assets, should the bank eventually become insolvent. If that did happen, you would be in a bad position. Your claim is against the bank's overall assets, not for your specific gold that you thought you owned. The bank's gold reserves would be diluted by non-performing assets, which do not sell well in a crisis. In the West, bank customers expect certain forms of protection that are provided by government institutions. However, this is limited to cash held by the bank. It does not ensure gold deposits at the bank. So it is important not to be impressed by assets being checked daily by bank regulators. Regulators are only concerned with ensuring the bank's liquidity reserve. They are not concerned with who put the gold in the bank to begin with, as it is now considered property of the bank, and can be sold to cover the bank's obligations, which is all the regulators are concerned about. Allocated gold allows you to retain ownership of the gold, rather than being put into the position of a creditor. So with allocated gold you are actually protected against a systemic failure, and your gold remains your gold. Unfortunately, with allocated gold, your money does the bank no good. Allocated gold is less attractive to banks, because it cannot be used to shore up their financial statement. And they cannot loan against, and therefore earn additional fees, using your gold. This is why banks often charge nothing for allocating storage and at least 1.5% for allocating storage. It should not be surprising that professionals in the bullion market suggest that less than 1% of gold traded in the financial markets is allocated gold. It is not only banks that provide unallocated gold. Fabrication businesses and pool account providers do, also. Anyone who can find another use for your gold has a reason to provide you gold on an unallocated basis. It's ironic that a huge majority of the world's owners of bank-stored gold fail to meet their primary objective. This is because the metals are not held in an allocated account in the name of the owner. We provide resources at our blog, where you can acquire precious metals that are held for you in insured, secure vaults abroad in an allocated account. Individuals who choose to invest with companies offering allocated gold accounts are not subject to counterparty risk, as is the case with certificates or other means, where someone else is holding their assets in an unallocated manner. However, there will still be performance risk, namely that the representations of the organization storing the gold are accurate, with regard to their fulfilling the obligations and promises made to the customer. To offset this risk, companies should provide regular audits of the stored gold, as well as for the company's general financial solvency. It is this independent third-party verification from a trustworthy auditor who ensures that customers' metals are there, in the vault, safe and sound. Gold mining shares, funds and derivatives. Gold exchange-traded funds. An exchange-traded fund, ETF, is really a portfolio of stocks, bonds, options, and/or any other instruments that trade on an exchange. They are carefully made to track a specific index, sector or group. Just like regular shares, they may be bought and offered with the click of the mouse button. They can be shorted and traded on margin and integrated into tax-free investment shelters. You can also set stop-loss orders as with stocks or options. ETFs charge under 1% per year and the opportunity to invest in any sector of the market. Non-commodity ETFs permit you to broaden your risk among otherwise hundreds of companies, and it is hardly surprising that ETFs grew popular in recognition during the last 2 decades. Gold ETFs obviously track the gold cost, though as a result of the operating expenses you have to pay on it, they'll always underperform the particular metal cost slightly. ETFs are financial items instead of physical gold. They are associated with the gold values, although not entitled to a particular volume of gold. With this thought, it's vital that you consider why you are investing in metals in the first place. If it is because you need to trade gold frequently, then ETFs may be the best option for you. The benefit of having the ability to buy gold using your existing stockbroker or trading platform is really a plus, especially when compared with the time and effort it requires to manage in coins and bars with traditional gold sellers. Imagine making trades through your online broker compared to running ads on eBay, then insuring and shipping individual pieces of gold to buyers. You'd have to love that business in order to do it regularly. Just like COMEX futures and options, gold ETFs offer the chance of playing each side of the gold game, as it is possible to short gold ETFs, meaning you profit once the gold price declines. How does this work? Whenever you are short something, whether it's a stock, commodity or bond, you borrow it from the owner and then sell it, with the hope of having the ability to purchase it back at a cheaper cost than you offered it for and ending up with a profit, based on your sell cost and the cost you were able to buy it back at, less commissions. These methods may be used effectively by seasoned traders, but they are less appropriate for almost all traders. The opposite of going short is going long, where own the shares and hope to gain on upswings in prices. You can only lose what you paid for the shares. With short selling, your potential losses are infinite. For most traders, gold ETFs start and finish with simple buy and sell orders around the actual stock. Convenience is really a major feature for ETFs, but retail traders should keep in mind that most ETFs are paper gold items that depend on the functioning economic climate to operate correctly. If you're purchasing gold as a hedge against concerns within the economic climate, ETFs are less appropriate. They provide no practical method for average traders to consider physical delivery of actual metals. Some ETF managers contract out storage to custodians, banks hired to keep the ETF gold, who then contract with sub-custodians to handle storage. The bottom line with ETFs is that you can make money trading them, as you can with trading a stock. However, you should never use an ETF for the purpose of or with the belief that you actually own physical gold that could protect you in the event of economic upheaval. You would never be able to actually put your hands on any of the gold claimed to be controlled by an ETF. Some prospectus may absolve the custodian from the liabilities developing from sub-custodian solvency, as the funds may absolve themselves of the responsibility to watch sub-custodians, despite these being the people entrusted using the fund's gold. Indeed, ETF trustees might have very limited legal privileges when it comes to oversight of sub-custodians. There's a wider legal point that individuals must consider here, for the reason that the net of ETF custodians and sub-custodians can spread across a variety of nations. In case of problems, courts in a variety of areas might take years to reach an answer. Just like certificates, gold ETFs depend on a third party. In the case of ETFs, there will be banks, which have been designated as custodians to ensure or back up the promise of the ETF to repay investors. This isn't exactly the same factor as possessing physical gold. It's smart to see the prospectuses of those items, as individual funds will vary from fund to fund. If you're only thinking about possessing gold for trading, as you would a stock, then ETFs could make sense. However, when you purchase gold as a way of avoiding counterparty risk, where you are relying on someone else's ability to pay, should you choose to liquidate your investment, then you should know that the ETFs do not provide you the security that an allocated gold account does. Pros: cost of management is comparatively low. You can trade it easily through online brokers. You can sell short and also buy sell derivatives, such as put and call options. Cons: can you be sure the ETF actually owns the metals they claim? You can't get metals delivered to you, if you chose to, and thus the security that comes from owning gold is not available with an ETF. Multiple third-party custodians leave you wondering who or how you would recover your investment if problems occurred with management. Gold-silver closed-end funds. At first glance, closed-end funds, CEFs, looks just like ETFs. Both trade on stock markets much like regular shares, and both represent shares supported by other assets. With closed-end gold funds and gold ETFs, it's the quantity of gold that they hold that provides these entities stock value. There is an obvious incentive to inflate the numbers to the degree they could get away with it. However, these superficial commonalities mask important variations. To begin with, CEFs possess a fixed quantity of shares outstanding. This really is as opposed to ETFs, that are passively run by fund firms that issue and redeem shares based on demand from investors. With CEFs, barring periodic share buybacks and secondary offers, traders may trade their shares around the secondary market. As far as gold CEFs are concerned, which means that the total amount of gold they own is bound for time periods, unless and until the fund decides to purchase more gold and issue more shares. Managers of CEFs must gauge interest in the actual assets they have committed to, as well as for determining whether to make additional offerings or whether to buy back existing shares. It is primarily the management that will determine whether CEFs trading is confined to the internet resource value or otherwise, as traders are going to be much more likely to trust their cash with managers who have established track records. Keep in mind, however, that active management means greater management costs than would be with passively handled the funds. Pros: flexible to trade, similar to a stock. Often offer allocated gold account with option to take physical delivery. Geo-diversification is possible. Premiums increasing in relation to net asset value would result in a gain. Cons: the fees for management. Premiums above net asset value are an increased cost of ownership, compared to other forms of ownership. Gold mining shares. In comparison, mining shares provide the chance of making gains from the price of gold, and may be appropriate as buy and hold opportunities. This is also true should you purchase a fund or ETF that invests in several companies, meaning you reduce the risk via diversification across many different producers. Two popular gold producers indexes would be the American Stock Exchange Gold Bugs, basket of unhedged gold stocks, index, symbol, HOA, and also the Philadelphia Silver and Gold Sector Index, symbol, gold. Dramatic run-ups within the gold prices usually result in significant gains within the stock values of the miners, as gold gains in accordance with their production costs. A 10% increase in gold price can often mean a 40% rise in a mining entity's profit. Many of the small producers and exploration companies have experienced huge gains in stock values in accordance with a rising gold price. The disadvantages of gold mining companies should also be considered. One of the most obvious is that whenever you buy mining shares, you're purchasing a stake in a human failure, in addition to the price of the metal it is mining. Mining accidents, as well as other on-site accidents, can instantly wipe billions from the market capitalization of even well-established senior producers. Miners face a political risk too, whether it's by means of windfall taxes, or, in worse situations, nationalizations and expropriation of investors' assets. On the top of that, a lot of mining traders in recent years, regardless of the theoretical gains resulting from gold prices, miners frequently don't outshine increases in the bullion value itself. Take into account that in the summer 2002, the HOA averaged 107.35, as the gold price averaged $314/oz based on the London PM fixes that month. 107.35 divided by 314 gives a HOA/gold ratio of 0.354. However, in the summer 2012, regardless of the gold prices going from the low $300s to $1,600 within the decade, the HOA/gold ratio was at 0.275. Therefore, the HOA, An altered equal dollar-weighted index of 15 from the biggest gold producers, really underperformed gold bullion over a 10-year length of the metal's latest bull market. This underperformance is much more striking considering the Huawei signifies unhedged producers, companies that aren't participating in forward sales of gold according to conservative price forecasts. Throughout a bull market, unhedged miners ought to be much more lucrative than those that hedge, because they sell gold at the current market cost. This will mean rising income and outperformance in accordance with percentage gains the price of gold. The current underperformance of gold shares in accordance with gold is even starker when evaluating the gold index, including hedged producers, to gold. However, past performance may not be a predictor of the future. Careful research and diversification across different producers may be the best choice, if you opt to go this road. You can find a link to a special report on investing in junior mining companies, and also resources, where you can trade gold and silver as securities and derivatives at buyandsellgoldbullion.com. Gold certificates. The guidelines regulating gold certificate schemes vary based on national law and also the designs of items. Nonetheless, there are a couple of general points that traders should consider before purchasing these items. A fundamental character associated with a certificate is the commitment of payment by the issuing association or government. During the time when the USA was on the gold standard, their foreign currencies were essentially equal to and considered gold certificates. Notes released by some banks were offering to pay the bearer of the note an equal amount in gold on demand. Today, when you purchase a gold certificate, you become the unsecured general creditor of the bank, mint or trading firm that released the certificate. This is comparable to the procedure that happens whenever you deposit money in the bank. In the two cases, your resource, whether it's a certificate of money deposit or perhaps a gold certificate, is the resource, but it is a liability on the balance sheet of the entity that issued it. In these cases, there is nothing physically backing up your loan or investment, and you are relying strictly on their promise to repay you. This is an important distinction to understand, in contrast to owning and storing physical gold. Certificates introduce some counterparty risk. Counterparty risk is the risk you are taking whenever you accept someone's promise to repay you. The individual or firm extending the promise is the counterparty, and the gold placed on deposit with them equals a liability on their balance sheet. You become their creditor, so their financial strength is essential to the safety of your investment, not just the value of the gold itself. Their financial capacity determines the likelihood that the gold is going to come back to you after asking your counterpart to return your gold, or the equal value. Pros. It offers an inexpensive means by which to stake a claim to large amounts of gold-silver in comparison with buying physical gold. It can offer a means of geopolitical diversification. Cons. You are at risk of the issuer of the certificate remaining solvent. Your metals will generally be unallocated. You may not have the option to get physical metals upon redemption. Gold futures. Gold futures and options are exchanged mainly within the Commodity Exchange in New York, COMEX, a subsidiary of Chicago-based CME Group Corporation. The fantastic attraction of futures is that they supply the tantalizing prospect of utilizing gains associated with gold prices. The particular sum of money you have to establish to use a scenario is a part of the hypothetical price of anything, probably around 5%. So using 5%, for instance, to use a long position of the standard 100 ounces COMEX gold contract, which in a gold price of $1,650/ounce features a theoretical price of $165,000, you would only need $8,250 in order to control and profit from the movement of 100 ounces of gold. Cash settlement on futures positions happens every single day. This is often a necessary reason for stalling delivery for just about any commodity, as without daily settlement people who had gotten into deals that subsequently went against them could bid farewell to their obligations. The potential for rapid gains is offset by the potential for losing even more than you started with. Individuals who are savvy when it comes to trading could make huge gains, very rapidly from futures. However, many people generate losses trading futures, and they're not appropriate for most savers and investors seeking a buy and hold positions in gold. For speculation in base metals, both futures and options, one might need to look outside of the United States for opportunities that are not easily obtainable at the US-based futures exchanges. A sure sign of how the markets have become global is that now it can be easy to trade futures in your account that are in an international futures exchange. The most active ones are London Mercantile Exchange, LME. They offer futures and options on zinc, lead, nickel, tin, aluminum, and copper. Eurex. This is a European futures exchange very active in monetary instruments such as derivatives. Tokyo Commodity Exchange, TOCOM. They have precious metals futures contracts, as well as a number of remarkable ones such as rubber and kerosene futures. See our blogs at buyandsellgoldbullion.com for more resources on how and where to trade gold or silver storage and transport. Storage facilities earn their money through storage fees, and sometimes though buying and selling, also. We discussed above the potential drawbacks of storing precious metals yourself, at your own premises. And for those choosing to diversify their wealth, including geographically, it is usually not practical to handle and store metals yourself. That being said, being able to put your hands on some metals, in the event of any catastrophic economic situation, may be very sensible. That would be just to cover basic needs during crisis circumstances. Storing physical precious metals. Pros. You actually own and control the physical metals. You can diversify between gold, silver, platinum or palladium. You can have your assets stored in multiple countries. It's easy to issue buy-sell orders electronically. Depending on the dealer, may have the option to take physical deliver upon request. Cons. The cost to store the metals. Some dealers may not offer the physical delivery option. Audits should be available for all customers. Furthermore, ultrasound checking of gold bars and comprehensive governance methods are additional essential assurance standards. How about buying, selling and storing through an online platform versus buying from a dealer and having shipped by into a company that provides transportation and vault storage? Considering that both types of dealers are probably using one or both of the largest such companies that provide such service, it really comes down to one's own preference. And if diversification for ultimate protection is the objective, then possibly doing both is not a bad choice. Before we speak about the two main players in the field of transporting and storing precious metals, let us mention one other possibility for storage, if the amounts are relatively small. That would be using a safe deposit box at your local bank. For someone who is trying to diversify their wealth and is therefore purchasing larger amounts of metals, you probably want to avoid having to handle or ship or store these larger amounts yourself. At least if you put your gold into a safe deposit box, versus an unallocated account, it remains your gold and no one else has a claim upon it. However, in the event of a bank crisis or other disaster, you may not be up to get to your metals when you literally need them for your survival. But it is an option to be considered for smaller amounts. And a bank vault should be more secure than a safe in your bedroom closet, for example. The main players in storing and shipping precious metals. The Brinks Company. From their own corporate website, the Brinks Company is a premier provider of secure logistics and security solutions including cash in transit, ATM replenishment and maintenance, international transportation of valuables, cash management and payment services. Our customers include financial institutions, retailers, government agencies, including central banks, mints, jewelers and other commercial operations around the world. Our global network serves customers in more than 100 countries. We have ownership interest in companies in 41 countries and agency relationships with companies in additional countries. We employ approximately 59,900 people and our operations include approximately 1,100 facilities and 12,000 vehicles. Brinks was founded in 1859 and our headquarters are located in Richmond, Virginia. Loomis International. From their own corporate website in March 2015, Loomis International Services and Met International were united in the new brand Loomis International. The company is the specialist at creating efficient, risk-controlled international end-to-end transport solutions along the value chain. We have a strong international presence and are offering our services in 110 countries. We offer comprehensive solutions for valuables for financial institutions and industrial companies. International presence. Loomis subsidiaries in Argentina, Brazil, Austria, Canada, China, the Czech Republic, Denmark, Finland, France, Germany, Norway, Portugal, Slovakia, Spain, Sweden, Switzerland, Turkey, the United Arab Emirates, United Kingdom and the United States. Met International would have been on this list, as they were also a major player. But as stated above, they have merged with Loomis International, mentioned above. Well, their description pretty much says it all. Consider the amount of assets being trusted to these companies, and the governance to which they have to operate under. Even if you are fortunate enough to have a very large estate that you are managing, it's still barely a speck, considering the total amount cash and hard assets that either of these companies is responsible for in transportation and/or storage. Bullion Vault uses both Loomis and Brinks, thus affording the ability to trade in multiple currencies and store in multiple countries. Pro Aurum Group. The Pro Aurum Group is one of the leading physical precious metals dealers outside the banking system within the German-speaking countries. The group operates many offices within Germany, Switzerland, Austria, and Hong Kong. The company was founded in 2003 and today employs more than 100 employees all over, with a turnover beyond €1 billion per year. The customer base varies from retail to high net worth as well as institutional customers and banks. This is who stores metals for Voltoro, below, for those seeking to buy gold with Bitcoin. Chapter 7, I.R.A. Savings Plans and Alt Currencies. Below are a few savings plans offered to savers in the United States. Other countries have similar programs with similar options to invest savings into gold, silver or cryptocurrency. You need to consult the rules in your particular country and situation before deciding which course of action is right for you. IRA, Individual Retirement Account. The Individual Retirement Account, called IRA for short, is a legal means for investors or savers to defer taxation of capital gains until retirement. Many companies allow past and present employees to roll over the proceeds from a 401k plan to an IRA called a rollover IRA. Various types of electronically traded assets can be held in a typical IRA account. For example, you could hold gold stocks, or shares in an ETF, and now even cryptocurrencies can be placed in an IRA. However, if you're going to hold paper or digital investments, then there's no reason to focus on precious metals. You can buy anything that you believe may appreciate over time. If, on the other hand, you are interested in gold-silver for your IRA account is to hold or control the physical metals, because of concerns over the security of the economic or political system, then you definitely want to focus on approved coins, ingots or bars to be safely stored in your name. Precious metals allowed for IRAs. The following coins are examples of the types of coins that are allowed to be placed in an IRA. American gold, silver, and platinum eagle bullion coins. Canadian gold, silver, and platinum maple leaf bullion coins. It can include gold, silver, platinum, and palladium bars and rounds manufactured by a NYMEX or COMEX approved refiner/assayer and meeting minimum requirements. They can be 1,000 ounces or 1,000 ounces bullion bars. There are other coins that specifically meet the IRS requirements for inclusion. You may want to consult a trustworthy and professional gold dealer to help you set up your precious metals IRA account and to determine which types of products meet the requirements. Dealer, custodian, storage facility for gold IRA. You would order your metals through a dealer, and they will work with the IRA custodian for logistics such as where and how your gold, silver, platinum or palladium is to be shipped for authorized storage. The certified storage is vital for two reasons. First, the security of your investment is only as secure as the company storing your metals. Second, having an approved storage facility is one of the requirements to setting up a precious metal IRA that lets you invest in the actually physical metals. It's well worth your effort to set up, especially if you have a significant amount of money sitting in an IRA or 401k already. Why not make it as secure as you possibly can with physical metals? That is, if you have concerns about political and economic factors affecting your money. How is a 403b different from a 401k? The main difference in these two plans is the type of employers who can offer them. 401k plans are offered by for-profit companies, whereas 403b plans are only available to employees of tax-exempt organizations. These usually include schools, hospitals or religious groups. What is a TSP plan? The United States government offers various types of retirement plans to plans employees and to members of the various branches of the military. Through the Federal Employees Retirement System Act of 1986, FERS, Congress established the TSP as a 401k-style alternative to public workers. It is possible to roll over a TSP plan into an individual retirement account, IRA, a 401k plan, or other select qualified plans. It is advised that you select the option to perform a direct rollover with your TSP funds. This way, you never receive a check for your distribution. Rather, your TSP plan provider will transfer the money directly into your new IRA plan. Regal Assets is a great place to get free advice and assistance with gold or silver and now even cryptocurrency rollover. They can also advise about storing offshore, when that option is available and desired. Cryptocurrencies and IRA account. Individual retirement accounts, IRAs, allow for you to make investments and potentially earn tax-free or tax-deferred profits. Account types available are traditional, Roth, SEP, or simple. Each account may have different eligibility requirements and annual contribution limits. Individual, cash, account. Individual accounts are a non-retirement account where there are no limits to how much money you can deposit and money can be withdrawn at any time. You are responsible for taxes generated from any gains from a sale of an asset in the year the sales proceeds are received. Play Money account. Create a simulated account where you can test our platform before you open an account and start investing. Further information on crypto IRA and links can be found at our blogs at buyandsellgoldbullion.com. Chapter 8, Bitcoin and Cryptocurrencies. You can find further, in-depth information and links to various crypto exchanges, online and offline crypto wallets, a free crypto privacy report and other guides at our blogs at. Bitcoin is most common of what has become numerous different cryptocurrencies. Cryptos, as they are called, are digital currencies that governments can't control or dilute. They're alternatives to paper money. And they allow people to pay and receive money, without having to go through a centralized system. Due to devaluation of paper, fiat currencies globally, cryptocurrencies continue to grow in popularity. Why cryptocurrencies make good money? Ease of online shopping. Bitcoin provides probably the easiest means of payment for online shopping. We can expect more and more online businesses to accept Bitcoin, over time. Of course, between individuals, Bitcoin is surely the easiest way to exchange payment, as there is no need to involve anyone or any institution. Less volatile than cash. Due to people's insecurities about governments, globally, Bitcoin is often preferred because it is independent of any national currency. Great means of settling trade. Unlike national currencies, the price of Bitcoin does not need to be converted, depending on which country you happen to be located. In this way, Bitcoin is similar to gold, providing an open market with no restrictions that would otherwise be created by banks or governments. Bitcoin is peer-to-peer and open, yet secure. Bitcoin allows individuals to exchange value over the internet without any intermediary and gives the users access to their balance to a password known as a private key. Therefore, it's private, secure, and at the same time, it's open. Global economic instability. The 2008 economic collapse was due to unsustainable debt instruments. But the debt has only continued to increase. And many believe some type of currency crisis is inevitable. But no one can say for certain when it will be. How long they can kick the can down the road. But the good news is that the value of Bitcoin is not closely tied to either stock market or national currencies. Bitcoin could actually increase in value, as a result of decline in traditional currencies, which suggests that it could be wise to diversify some funds into Bitcoin. Duplication impossible. Unlike cash, there is no way to duplicate Bitcoins. Bitcoin usage is increasing globally. Bitcoin usage continues to grow rapidly. More variety of goods and services are bought and sold with Bitcoin daily. In China, Bitcoin is used increasingly to move funds out of the country. And in Venezuela, where the national currency has been losing value, people have been turning to Bitcoin as a way of preserving the value of what they have. Anywhere people are concerned about the value or stability of their currency, people are considering Bitcoin as an alternative means of not only a means to buy and sell, but also to hold and store wealth. And certainly gold and silver offer the other two best alternatives. What is the blockchain? What is a block? A block is just a record in a system. It could be a simple identification number and a status, or a complex list of transactions. Blocks contain certain information which allows them to be uniquely identified from other blocks, and store the information that we want them to. When more than one record exists, they are linked together using cryptography. This link is made by using the hash of the previous block. The first block in the chain cannot contain the hash of a previous block, or a Merkle root. This is called the Genesis block. What is a blockchain? A blockchain is a continuously growing list of records, like a traditional ledger, where records are entered line by line. But unlike the ledgers we are used to, where there is one central copy, the ledger is duplicated and distributed to everyone on the network. Once the records are linked, they become a chain. This chain is permanent and they can never be altered. The next block always contains the previous block's hash, and that joins them permanently together in an unalterable sequence. What are nodes? A node is a powerful computer that runs the cryptocurrency software and keeps the blockchain alive. Running a node is as simple as downloading free software and configuring a normal computer, with enough storage space and processing power. But, running a node consumes a lot of energy and requires a lot of storage space. Nodes send information about cryptocurrency transactions across the network to other nodes that it is aware of. A node doesn't need to know all the nodes in the network. Each node is aware of different nodes, and so the network grows and the information gets spread across the entire network quickly. Types of node. Some of the nodes just spread the information across the network, and others additionally perform the task of mining. The mining nodes group outstanding transactions into blocks and adding them to the blockchain. To validate the transactions, they must solve a complex mathematical puzzle to find a number that is the result of combining the data in the block and passing it through what is called a hash function. This produces an integer, number, which is called a nonce. What is a hash function? The hash function disguises the number in such a way that it is impossible to predict the output. The mining nodes have to guess the number. It is impossible to know which number will work. Two consecutive integers produce very different results, and there may be more than one nonce that produces the result, or there may be none. The more attempts a miner makes, the more likely they are to guess the answer, so more power generally means more chance of success. But the element of randomness means that some smaller miners can get lucky. The more miners that join the network, the more complicated the hash becomes, which is an intentional way designed to balance the number of blocks that can be found. On average, this is one block every 10 minutes. When a miner gets successful hash result, it is announced to the whole network and the miner gets a financial reward. As there is no point in other miners continuing to try to guess, validate the transaction and start work on the next block. Security. If a hacker tried to maliciously change one of the blocks, the next block would not contain the correct hash, so the chain would break. Even if someone were successful in maliciously updating all the subsequent blocks, as there is no single copy where the data is stored, all the nodes in the network wouldn't be the same. The majority would overrule the node that was changed, as consensus would not be achieved. The 51% attack. But there is a well-known problem with majority consensus in a blockchain. Only 51% is required to be a majority, so if 51% of the nodes were compromised, the information they hold would be considered true and would overrule the remaining 49%. This is called the 51% attack. Why blockchain? Blockchain was developed to provide a more open, more secure and cheaper way of completing transactions between two entities by offering an alternative to the traditional trusted third-party method of verification. By relying on consensus to verify transactions and removing the need for a middleman, many tasks can become cheaper and quicker. Blockchains can be public or private, but this peer-to-peer approach provides enhanced security against hacking and fraud, which allows easy, secure transfers between parties. Through its open ledger, it allows easy auditing for additional security and can be used for a variety of purposes, from proving ownership, verifying communications, transferring money, or even tracking items through a supply chain. Cryptocurrency is just the start. The possibilities for blockchain are endless. Be on the lookout for more innovative ways that blockchain is implemented to improve our lives. Easy payment using cryptos. Bitcoin is a new and innovative digital currency that can be accessed anywhere online. The Bitcoin system is based on cryptocurrencies and is accepted worldwide. Bitcoin works on peer-to-peer, peer-to-peer technology and works without the need for central authorities or regulators. Bitcoin is a valuable form of cryptocurrency, as there are always up to 21 million units in the market. In addition, new Bitcoins are being generated at a decreasing rate. Compared to other online trading systems like PayPal, Bitcoin uses peer-to-peer, so there is no third party to complete the transaction. Bitcoin can help you save on transaction costs. Bitcoin can help reduce costs, especially for people with a lot of virtual transactions and online businesses. Also, currencies are decentralized. This means that the currency is free from government control. Regular banknotes and coins are controlled by a statutory body that oversees the printing and distribution of the actual coins to the general public. To make using Bitcoin even easier, many companies offer users Bitcoin wallet apps for smartphones. You can now buy and sell Bitcoin just by tapping your smartphone. For Android users, you can find many mobile applications for buying and selling Bitcoin on the Google Play Store. To increase the security of Bitcoin wallets, most people download and install a desktop client and save Bitcoin transactions on their computer. After starting your Bitcoin wallet, always keep your files and don't forget to back them up to your desktop from time to time. Unlike banks, you are responsible for the safety of your currency and money. The Satoshi client has been around since 2009 and is widely used by Bitcoin users. Once you have your wallet, you can sell Bitcoin. There are several ways to help you get this cryptocurrency. You can buy Bitcoin from different sellers, get them from trades, perform simple tasks, work to get free Bitcoin and mine Bitcoin. Demand for Bitcoin has been growing for many years, and it is expected that demand will continue to increase as the real currency depreciates. If you want to learn more about the concept of Bitcoin and how it can help you and your business, search the internet for more details. Asia's new Bitcoin ATM, a new step in the game, is now available in Asia. This new ATM is based in Hong Kong. More specifically, it is the Mongkok area that operates from March to April, according to the operator. The new Bitcoin ATM concept adapter has announced that it will offer the highest Bitcoin prices through a partnership with established exchange bitcashout.com. ATM offers the most customer-friendly service by providing user-friendly endpoints, high-speed transactions, and security. This new ATM offers the ability to easily buy Bitcoin with fiat instead of wasting time waiting for bank transfers or other less advanced methods. The operator of this new Bitcoin ATM has opted for an innovative, low-cost reward system and has recognized Bitcoin for various contributions from the crypto community, such as articles and videos. Crypto exchanges. Crypto exchanges come mainly in two forms and can be broadly divided into centralized and decentralized exchanges. The decentralized exchange is interesting because it works on a peer-to-peer model. How does the centralized cryptocurrency exchange work? A centralized exchange is an exchange that retains control of all transactions made by a centrally operated operator. This requires a lot of trust in the exchange operator from you as a participant. After all, you have no control over the private key used to access your funds. If you want to make a transaction, you need to send a request to the exchange. The exchange enters the relevant data into its own database. Traditional exchanges like the stock exchange follow this centralized approach. So it's sort of a model of the past. Centralized exchanges can be used to trade fiat into cryptocurrencies, or vice versa. It can also be used to trade between two different cryptocurrencies. This seems to cover all potential transaction types, but there are still markets for other types of cryptocurrency exchanges. An alternative are decentralized exchanges. They eliminated the intermediaries and created an environment that is often seen as unreliable. These types of exchanges act as peer-to-peer exchanges. Assets are not held by escrow services and transactions are solely based on smart contracts and atomic swaps. The key difference between a central exchange and a decentralized exchange is the existence of an intermediary. Decentralized exchanges are less popular than centralized exchanges. Nonetheless, decentralized exchanges are always present and may fund decentralized exchanges in the future. Decentralized crypto exchange, DEX. In general, peer-to-peer exchange, i.e. all platforms for peer-to-peer exchange, can be decentralized exchange, DEX. A decentralized exchange can mimic the basic functionality of a decentralized exchange with certain advantages. This is achieved by these exchanges using blockchain for the back-end. Therefore, trust in the switch plays a much smaller role in this approach than in the central switch. An important difference to centralized exchanges is that you as the user hold the private key to your funds. You are no longer dependent on the stock exchange operator and, for example, retain control of your deposited coins. The decentralized exchange of digital assets is made possible by protocols like the 0x protocol, which runs on the Ethereum blockchain. What are privacy coins and why you care? When using traditional cryptocurrencies like Bitcoin, transactions are not completely private. Given enough time, a computer program or person can link your identity to your wallet address and use the information in your public ledger to work out how much cryptocurrency you have. While cryptocurrencies such as Bitcoin advocate decentralization, depending on the exchange, they are not actually decentralized or private. While privacy coins offer an additional layer of anonymity. This feature has sparked complex emotions both inside and outside the crypto industry. Privacy coins are difficult to regulate, and crypto advocates tend to seek generous relationships with government regulators. As a result, most of the community is trying to get rid of the image of anonymous coins. As a result, many outside of the crypto industry are misattributing the potential downsides associated with privacy coins, such as funding illicit transactions, to coins like Bitcoin, which are more transparent than the US dollar. The Canadian government is taking extraordinary steps to combat the Freedom Convoy. The New World Order government began freezing bank accounts and blacklisting cryptocurrency wallets over alleged dislikes. They are also targeting protesters on criminal charges. Trudeau's Attorney General David Lametti, for example, recently said that Trump support is one of the factors in whether a Canadian bank account is seized or frozen. As of Saturday, February 19, 2022, the Canadian government had already frozen at least 76 bank accounts worth approximately $3.2 million. There have also been rumors of late that the bank run could be triggered by panic over temporary downtime at a major Canadian bank. Bitcoin is not private and can effectively be frozen, censored and used to track and trace your activity. Bitcoin, like all public cryptocurrencies, can be censored at the exchange or even wallet level if the powers that be wish to do so. In addition, your identity can be linked to your activities through blockchain analysis. Even Americans who have donated to Canadian fleet efforts have come under public attack and harassment in the recent security breach of GiveSendGo, a crowdfunding platform that leaks personal information. This is very painful for those trapped, but there is no doubt that the Canadian government's action was a last resort of sorts. In doing so, they reveal the facts about cryptocurrencies as a tool to avoid government reprisals. There was an ingenious move to make the average person believe that Bitcoin is private and uncensored. This was done consciously so that as many people as possible would have property confiscated, arrested and censored, which they have now started doing. Currently, only 2 major cryptocurrencies that are truly private. And thus, they are secure of surveillance, censorship and seizure. They are Monero, XMR, and Pirate Chain, ARRR. Monero and Pirate Chain are fundamentally different from everything else in that they are truly private. When used correctly, nobody but you will know that you sent them to someone else. In other words, they can prevent it from happening to you. By using Monero and Pirate Chain, your privacy is secure, even if you are the recipient of the funds. Of course, if you don't want them to know, they don't know who it came from. See our blog to access a free report, special report to Canadians on crypto privacy. How to buy gold with cryptocurrencies. Vaultoro, founded in February 2015, is an excellent service that enables you to actually move money between gold and Bitcoin in seconds. Then you can use Bitcoin and multiple other cryptocurrencies for buying and selling, but it's also good to know that this company really seems to be in the right place at the right time with this service, and they are up to the highest standards. You can trade from crypto to investment-grade bullion and back. Crypto can bring large gains, gold is to preserve those gains without dealing with banks or fiat. Vaultoro gives you easy access to professionally vaulted, fully insured gold bullion. Features include real-time trading between physical gold and Bitcoin. Trade a minimum of 5 cents worth of Bitcoin or gold. Gold is audited and insured. Bitcoin holdings are publicly audited and help in multi-sig cold storage. Gold is held in the customer's name, so if something was to happen to Vaultoro, clients have full ownership and rights to their gold. No need to verify your identity unless you want to deposit more than $5,000 worth of Bitcoin per day. 0.5% to 0.2% trading fees depending on trader's 30-day volume. All gold is vaulted in professional bullion vaulting facility within Switzerland's duty-free zone. Your gold at Vaultoro is secured in your name as your legal property within top-tier Swiss vaulting facilities, fully insured and audited by one of the largest auditors in the world, BDO. It's worth checking out. Learn more at our site at buyandSellGoldBullion.com. Chapter 9, Personal Finance and Investing Tips. When to enter the precious metals market. So then the question arises, when should one start to convert paper and digital money into precious metals or other assets with intrinsic value? There's a famous quote by famed investor, Warren Buffett. When asked about how he has often made such highly successful investments, he has stated that for him, it has not been so much about timing the market or short-term technical indicators. He has invested based on the fundamentals, that given his extensive research, he believed he knew which companies had the greatest potential. However, he has stated that his success has not been as much about how to time the market, so far as when to get in, as much as it has been about time in the market. Buffett has stated that many investors watch their investments too closely, trying to enter and exit on every up and down. Whereas his strategy has been to see what will be profitable over time and just do the right thing over the long term. The question for investors and savers today is, what are your motivations? If it's short-term gains with profit taking on movements in the market, then electronic trading is an option and is mentioned below. If you are first concerned with protecting what you've got and secondly, the hope of future capital gains, especially considering inflating money supplies, then investing in the physical metals may be worth your consideration and is also discussed below. Dollar cost averaging. If one was feeling very insecure about the safety of their wealth in the current climate and circumstances, then they might consider converting paper and digital wealth to precious metals or other tangible assets as quickly as possible, just so they have something with a tangible value that they can rely on, in the event of the unthinkable actually happening. This is a question each person has to ask themselves and/or their advisors that they trust, and then come to the best decisions they can. Another strategy, if urgency, due to the current or imminent future economic political climate is not the overriding factor, is to simply set a plan of making regular purchases or transfers, over time. This way, you don't worry about the temporary ups or down. You don't need to study technical charts and the like. You have made a decision in advance for reasons other than short-term profit. And so, just sticking to a plan of entry regardless of temporary gyrations of the prices allows you to average your purchase price, over time. Sometime your purchases may appear to have great gains and at other times they may appear to have temporary losses. But you still have control of the physical metals. No one can take that away from you, not if you have it secured properly, as we discuss below. And this having control of the physical gold-silver is the allure of owning precious metals. The safest ways to offshore and store wealth. While Bitcoin holds much in common with gold and silver, so far as a global currency that anyone in the world will recognize as a currency. It also has a globally agreed upon value that can be attained instantly. It makes good sense to use gold and silver as a primary store of value, since your gold or silver is hopefully vault stored in your allocated account. Or it could be stored in your home, depending on how you have set it up. The point is that an accident that could happen to a digital file that could result in the loss of an entire Bitcoin account. If your primary holdings are instead of gold and silver, then even if you suffered a catastrophic loss such as fire at home or office, or memory loss, your gold is still sitting in the same vault. And it will be there, even for heirs who will inherit it. Obviously, there are risks with keeping large amounts of cash or gold in the home, and so many prefer off-site vault storage for that reason. However, it makes good sense to have small denomination coins or bars on hand to use for trade in the event of a currency crash or something that could affect currency values overnight. Just review that image from the Weimar Republic one more time, to get the gist of what it can be like in the event of the unforeseen. Silver is probably best for this, to have on hand in case paper became worthless. But the bulk of your estate, if you have sufficient reserves to want to stash them someplace or a few places safe, then this book is written with you in mind. Of course, many open offshore bank accounts as a way of moving money out of the country. But with precious metals and Bitcoin, there should be no need for a bank account for either settling trade or storing wealth. Using Bitcoin and gold and silver seems to be a much better alternative to opening an offshore bank account, regardless of whether it's in Switzerland, the Caymans or Panama, which have all been favorites for offshore accounts. With the companies referenced in this book or our blogs, it is possible to have gold and silver securely stored in multiple different countries. Highly liquid and available to you, and yet your money is not backed by gold, you actually own the gold. Someone else just happens to be storing and keeping track of it for you, and they are rigorously audited to make sure they are adhering to the strictest standards. Why you should invest. Investing has become increasingly important over the years as the future of benefits becomes uncertain. People want to secure their future and depend on social benefits and sometimes severance pay. They wake up rude when they no longer have a stable income. Investing is the answer to an unknown future. Maybe you've been saving money with a low-interest savings account for years. Now you want the money to grow faster. Perhaps you have inherited money or received unexpected income and need a way to increase that money. Here too, investments are the answer. Investing is also a way to get what you want, whether it's a new home, a kid's college education, or expensive toys. Of course, your financial goals will dictate the type of investment you make. If you want or need to make a lot of money right away, you will be more interested in investing at a higher risk, which will bring you greater profits in the short term. When you are saving money for something in the distant future like retirement, you should make a safer investment that will grow over time. The overall goal of an investment is to create wealth and security over a period of time. The important thing to remember is that you may not always be able to make an income, you will eventually want to retire. We cannot expect the same from the Social Security system. As we've seen at Enron, you can't always rely on your company's compensation system. Again, investing is the key to securing your financial future, but you need to invest wisely. What is your investment style? Knowing your risk tolerance and investing style can help you make smarter investment decisions. There are many different types of investments you can make, but there are actually only 3 specific investment styles, and these 3 styles are related to risk tolerance. 3 investment styles: conservative, medium, and aggressive. If you find that your risk tolerance is low, it's no surprise that your investing style can be conservative or, at best, moderate. If you have a high risk tolerance, you are likely a moderate or aggressive investor. At the same time, your financial goals also determine your investment style. If you are looking to save for retirement in your early 20s, consider choosing a conservative or moderate investment style. However, if you want to raise money to buy a home within the next year or 2, you need to use a positive investment style. Conservative investors want to keep their initial investment. In other words, if you invest $5,000, you want to make sure you get the first $5,000 back. This type of investor typically invests in common stocks, fixed income securities, and money market accounts. Interest-bearing savings accounts are not uncommon for conservative investors. Medium-sized investors usually invest like conservative investors, but use some of the money invested for riskier investments. Many medium-sized investors invest 50% of their assets in safe or conservative investments and the rest in riskier investments. Aggressive investors are willing to take risks that other investors don't. Invest a lot of money in riskier companies in the hopes of generating greater profits, over time or in a short period of time. Aggressive investors often tie all or most of their investment funds to the stock exchange. Again, The investment style you choose depends on your financial goals and risk tolerance. Regardless of the type of investment you are making, however, you should carefully consider such investments. Don't invest without complete information. Stabilize your current situation before investing. Before considering investing in any type of market, it is really necessary to take a closer look at the current situation. Investing in the future is fine, but it is more important to find out what is wrong now and what could be wrong. Get your credit report out. This should be done once a year. It is important to understand what your credit report says and get rid of the negative elements of your credit report as soon as possible. If you've secured $25,000 for your investment but have $25,000 in bad credit, it's a good idea to clear your credit first. So check how much you are paying each month and save unnecessary costs. For example, you don't need a high-interest credit card. Pay them and get rid of them. If you have unpaid high-interest loans, pay them back too. Swap at least one high-interest credit card for a low-interest card and refinance a high-interest loan with a low-interest loan. You may need to use some of your trust to address these issues, but you will eventually find that it is the most rational course of action. Put yourself in a good financial position and improve your financial position through safe investments. If your bank balance is always low or you are struggling to pay your monthly bill, there is no point in starting the investment. Your investment is most commonly used to deal with the negative financial problems you face on a daily basis. Find out more about the different types of investments and try to understand your current financial situation. So when you are financially stable, you are armed with the knowledge to make an equally reliable investment in your future. Avoid impulse purchases. Please answer these questions honestly. 1. Is your spouse or partner dissatisfied with spending a lot of money? 2. Are you surprised every month when your credit card bill pays more than you think? 3. Are there more shoes and clothes in the closet than you could ever bring? 4. Do you have any new equipment before the seller's shelves collect dust? 5. Are you buying something you didn't want until you saw it in the store? If you answered yes to 2 of the previous questions, you are wasting your urge in retail. This is not good. This will save you money on important things like home, new cars, vacations, and retirement. You need to set yourself financial goals and not spend money on things that don't really matter in the long run. Impulse buying puts a strain on not only your finances, but your relationships as well. To overcome the problem, you must first learn to separate your needs from your desires. Advertisers attack us by offering our products 24/7. The trick is to think a little before buying something you didn't plan on. When you go shopping, make a list and collect enough money to pay for what you want to buy. Keep your credit card at home. When you find what you really need, wait 2 weeks to see if it's really what you need or if it's easy. By following this simple solution, you will correct your financial barriers and relationships. Use money wisely to save money. Have you ever noticed that what you buy at a grocery or hardware store every week increases the cents between purchases? Not so many, just a little each week, they keep increasing. All it takes for a significant price increase is a small collapse of the world market. Note gasoline prices in the context of world affairs. There is a way to contain such price increases by having such a strong impact on our personal finances, as much as possible for what we buy in bulk, use and continue to use on a daily basis. Find the best price. It can be kept on the shelves of our home as well as on the shelves of grocery and hardware stores. For example, cat and dog food costs around 10% less when bought occasionally than the full can price, and if you wait for the price to drop, you'll save even more. Free up space in your home and make a list of the ones you use regularly that don't get worse. Please note that cereals and cereal products must be stored in a closed container without mice. So you can find the best price available when shopping for bulk items like toiletries, dry food, and canned foods. You will be surprised at how much you can save by purchasing a 20-pound bag of rice instead of 1 pound, but remember that it should be stored in a rat-resistant container. You can buy some items of clothing such as socks and men's underwear. These styles do not change, so avoid buying clothes for children and women. These styles change and their sizes change exponentially. Make sure you have these items in stock for 2 years. This will save you hundreds of dollars. Types of investments. Generally, there are 3 different types of investments. This includes stocks, bonds, and cash. Sounds easy, doesn't it? From that moment on, it becomes very complicated. As you can see, for any type of investment, there are many types of investments that fall into this category. There is a lot to learn about any type of investment. The stock market can be a great place of intimidation for those with little or no investment clue. Fortunately, the amount of information you need to study depends on the type of investor you are. There are also 3 types of investors: conservative, medium, and aggressive. Different types of investments also face two levels of risk tolerance: high risk and low risk. Conservative investors often invest in cash. This means they put money into interest-bearing savings accounts, money market accounts, mutual funds, U.S. Treasury Department bills, and certificates of deposit. This is a very safe investment and will grow over the long term. It is also a low-risk investment. Average investors can often invest in cash and bonds to reach the stock market. Medium investments may involve low to medium risk. Medium-sized investors often invest in low-risk properties. Aggressive investors usually make most of their investments in the stock market, but there is risk. They also tend to invest in high-risk businesses and real estate. For example, if an aggressive investor invests money in an old apartment building and then invests more money in a property renovation, they are at risk. They expect to be able to rent more apartments or sell the entire property to benefit from the initial investment. This may or may not work. This is a risk. Before you start investing, it is very important to find out about the different types of investments and what they can do for you. Be aware of the risks involved and pay attention to past trends. History repeats itself and investors know it right away. How much money do you have to invest? Many new investors believe that all savings should be invested. This is not always true. To determine how much money to invest, you first need to determine how much you can actually invest and what your financial goals are. First, let's take a look at how much money you can invest right now. Do you have savings to use? If so, great. But you don't want to stop your business by investing money in your investment. Were your savings spared in the first place? It is important to save 3 to 6 months of living expenses in an easily accessible savings account. Don't invest this money. Don't invest money that you may need quickly in the future. So first decide how much of your savings should remain in your savings account and how much can be used for your investment. This is probably the only thing you need to invest at this point, unless you have funding from some other source, such as a newly acquired inheritance. Next, determine how much you can add to your future investment. If you are an employee, you will continue to earn, and over time you may plan to use some of that income to build your investment portfolio. Talk to a qualified financial planner to plan and determine how much of your future income to invest. With the help of a financial planner, you can be sure that you are not investing more or less than you should in order to reach your investment goals. Many types of investments require a certain amount of initial investment. I hope you have done your research and found an investment that is worthwhile. Then you probably already know what initial investment you need. If the money you need to invest doesn't match the original investment you need, you may need to consider other investments. Do not borrow money to invest or spend the money you have set aside to invest. Decide where to invest. There are different types of investments and there are many factors that determine where to invest the money. Of course, deciding where to invest begins by studying the different types of investments available, determining your risk tolerance and determining your investment style and financial goals. When buying a new car, you need to do a little research before making the final decision and buying it. You will never consider buying a car that hasn't been inspected or tested yet. Investing works in a similar way. Of course, you want to learn as much as possible about investing and see what investors have done in the past. Common sense. Researching the stock market and investing takes a lot of time, but that time is well invested. There are many books and websites available on the subject, and you can also take college-level courses on subjects offered by stockbrokers. With internet access, you can actually bet counterfeit money on the exchange and see how it works. You can create specific attachments and see how they work. Search using a stock market game or stock market simulation search engine. This is a great way to familiarize yourself with stock market investments. There is no simulator for any other type of investment besides the stock market. You should learn more about these types of investments by reading. As a potential investor, you should read everything there is to know about investing, but start with an investment book and website for beginners. If you don't, you will quickly get lost. Finally, talk to your financial planner. Talk to them about your goals and ask them for suggestions. This is your job. A good financial planner can help you easily understand where to put your money and achieve all your financial goals. Many will teach you how to invest in the process. Look what they tell you. Investment strategy. In most cases, the investment is not guaranteed, so it looks a lot like a game. The results will not be released until the game has been played and the winner has been announced. Whenever you play almost any game, you have a strategy. Investments are no exception. You need an investment strategy. An investment strategy is basically a plan for investing money in various types of investments that will help you achieve your financial goals at any given time. Each type of investment contains an individual system that you must select. Clothing stores sell clothing consisting of shirts, pants, dresses, skirts, and underwear. The stock market is a form of investment, but there are different types of stocks, each with different companies. Investment, if you haven't done the research, you can quickly get confused. Because you can choose between different types of systems and individual systems. This is where strategies combined with risk tolerance and investment style come into play. If you are unfamiliar with investing, work closely with your financial planner before making an investment. Not only will they help you develop investment strategies that suit your risk tolerance and investment style, they will also help you achieve your financial goals. Don't invest money without goals and strategies to get there. This is very important. Nobody gives their money to someone without knowing what it will be for and when it will be returned. If you don't have a goal, plan, or strategy, essentially do it. Always start with your goals and strategies to achieve them. Investment mistakes you should avoid. You can make some investment mistakes along the way, but there are also big mistakes that are absolutely essential to avoid if you want to be a successful investor. For example, the biggest investing mistake you ever made was not investing at all or postponing them later. Leverage your money even if you only invest $20 a week. Not investing at all or putting off afterwards is a big mistake, but investing before you are in a financial position is another big mistake. First, get an idea of your current financial situation and then start investing. Clean up your credit, pay off high-interest loans and credit cards, and save at least 3 months of your living expenses on savings. Once that's done, you can put your money to work for you. Don't invest to get rich instantly. This is the riskiest investment and is most likely to be lost. If it's easy, everyone will. Instead, invest long-term, survive the storm, and have the patience to grow your money. When you know you need the money right away, invest short-term only and stick to safe investments like certificates of deposit. Don't put all your eggs in one basket. Diversify it into different types of investments to get the most value for your money. Don't move your money too much either. Let it be. Choose your investment carefully and invest your money to raise it. If your stock drops a few dollars, don't panic. If the inventory is stable, it will increase again. A common mistake many people make is believing that their investment in collectibles will really pay off. Even if this is true, everyone will. Don't rely on the Coca-Cola collection or book collection to pay for your pension. Instead, bet on investments. Determine risk tolerance. Everyone has a tolerance for risk that cannot be ignored. Any good stockbroker or financial planner knows this, so they should try to help you determine your risk tolerance. Next, they need to work with you to find an investment that doesn't exceed your risk tolerance. The definition of risk tolerance includes several differences. First of all, you need to know how much to invest and what your investment and financial goals are. For example, if you plan to retire in 10 years and not save a dime on it, you need a high risk tolerance as you will need to make aggressive risky investments to achieve your financial goals. On the other hand, if you are in your 20s and want to start investing before retiring, your risk appetite is low. You can afford to grow your money slowly over time. Of course, understand that the need to have a high or low risk tolerance has nothing to do with how you feel about risk. Again, a lot depends on your tolerance. For example, what if you invest in the stock market, see the stock price move daily and fall slightly? Are you selling or letting go of your money? If you have a low risk tolerance, you will want to sell it. If you have a high risk tolerance, let your money go and see what happens. It doesn't depend on your financial goals. This tolerance is based on how you feel about your money. Again, a good financial planner or stockbroker can help you determine the level of risk you accept and choose the right investment. Your risk tolerance should be based on your financial goals and your assessment of your money's potential for loss. All of this is related. 7 things you need to know before investing. 1. Know your current financial situation. I know your debt level. Calculate your income and expenses taking into account the following points. Mortgage payment. Personal tax. Loans and overdrafts. Cost of living. Emergency fund. Car costs. Entertainment. Vacation. Entry fee. Credit card debt. Family duties. Before investing your money in investment products, you need to know how much you can save on your investment each month. As a general rule, pay off debts first, then save and invest. The more money you save now, the better for your future. My advice is to save 10% of your income for a rainy day. 10% is a small amount that won't feel runny. Please keep it until the dam management fund is created. 2. Prepare a means to manage the dam. This corresponds to point 1. As a dam manager, you must maintain your income for at least 3 to 6 months. If you are successful, You can invest the extra money you have saved. 3. Protect yourself and your family first. This means that you and your family must have basic life insurance to cover you and your family against life-threatening illnesses and accidents. This is very important, because investments can cost you all your money and they take care of you and your family when they need care. 4. Understand the level of risk. Short-term investing and swing trading are not for you if you can't take big risks. It is best to invest in a trust fund or trust fund that offers stable payments and is less risky. If you are prone to high or medium risk, try investing in stocks, growth stocks and hedge funds. 5. Diversify your investment. Experts will tell you that you need to diversify your investment. The investment requires a stable combination of stocks, trusts or bonds. It is also necessary to invest in different sectors and regions. This helps minimize risk as market volatility has little impact on the investment. The ideal combination is 20 to 40% stocks, the rest are mutual funds and bonds. 6. Do your homework before investing money. Get advice from an expert. But the money is yours in the end. Therefore, even if your financial advisor has everything sorted out, you still need to research and make the right decision on what to invest. This is necessary to know what you are investing in and keep track of it. When your investment takes a loss, knowing your business can make the right decision to sell or hold. 7. Take inventory every year, if not often. Your investment may already be worth it. But at the end of the day, it's good to know how good you are. Reinvest your profits and enjoy your success. This will motivate you and give you more determination to achieve your financial goals. Investment fundamentals. What are your investment goals? When it comes to investing, many aspiring investors want to get started right away. Unfortunately, only a few of these investors have been successful. Investing in something takes skill. It is important to remember that small investments certainly come with the risk of losing money. Before starting your business, it is best not only to know about investments and how they work, but also to define goals. What do you want to achieve with your investment? Do you want to finance university fees? Are you buying a house? When will you retire? Before investing a penny, think carefully about what you want to achieve with that investment. Knowing your purpose means you can make smarter investment decisions on the go. Too often, people invest in the dream of getting rich overnight. This is possible, but rarely. Starting an investment hoping to get rich soon is usually a bad idea. It is safer to invest money so that it grows slowly over time and is used for retirement or children's education. However, if your investment goal is to get rich, do your research as much as possible on short-term, high-yield investments before investing. Before making any investments, you should seriously consider consulting a financial planner. Financial planners can help you decide what type of investment to make to achieve your financial goals. He or she can give you realistic information on what types of returns you can expect and how long it will take to reach your goals. Again, remember that calling a broker and telling them you want to buy stocks or bonds to invest in them isn't enough. Some market research and knowledge is needed to expect a successful investment. Chapter 10: Estate and Retirement Planning. Investing for retirement. Maybe you're still a long way from the pension, or it's just around the corner. No matter how close or far it is, you definitely need to save money now. However, due to the rising cost of living and the instability of the Social Security system, old age benefits will no longer be the same. You should invest for retirement, not save for it. Let's take a look at the retirement plans your company offers. Previously, these plans were very rational. But after the collapse of Enron and all, people are no longer so sure about their retirement plans. If you don't want to invest in your company's retirement plan, you have other options. First, you can invest in stocks, bonds, mutual funds, certificates of deposit, and money market accounts. Do not tell anyone that the return on this investment will be used for retirement. Grow your money by working overtime, and once certain investments are mature, reinvest them and keep growing your money. You can also open a personal retirement account, IRA. The IRA is very popular because the money is tax deductible until you withdraw it. You can also deduct your IRA contributions from applicable taxes. The IRA can be opened at most banks. Roth IRA is a new type of retirement account. Roth allows you to pay taxes on the money you add to your account, but there is no federal monetization tax. Roth IRAs can also be opened with financial institutions. Another popular type of retirement account is a 401(k). The 401(k) is usually provided by your employer, but you can also open your 401(k). You will need to speak to a financial planner or accountant to help you with this. Keogh Plan is another type of IRA suitable for self-employed workers. Owners of small self-employed businesses may also be interested in the Simplified Employee Benefit Scheme, SEP. This is a different type of KEO plan which is generally easier for humans to use than a regular KEO plan. Whichever retirement plan you choose, pick one. Again, don't rely on Social Security, your company's liquidation system, or even inheritance that can be earned or not. Look for the future of your finances today by investing in them. 5 benefits of long-term investing strategies. Both short and long-term trading can be effective trading strategies, but long-term trading has some important advantages. These include the effects of compound interest, the likelihood of receiving dividends, mitigating the effects of price fluctuations, allowing for more timely corrections, and reducing the time it takes to monitor inventory. 1. Compound interest. Time can be an investor's best friend as compound interest gives you time to work mysteriously. Compound interest is a mathematical process in which interest on your money, in turn, earns interest and is added to your principal. 2. Dividend. Owning shares to generate dividends is another way to increase the value of your investment. Some companies offer the option to reinvest dividends through additional share purchases, increasing the total investment. Furthermore, the dividends reflect the overall business strategy and success of the company, rather than the volatile price fluctuations caused by market sentiment. 3. Reduce the effects of price fluctuations. With long-term investing, people are less prone to short-term volatility. The market tries to take into account all the factors that constantly change in the short term. As a result, long-term investors and traders are less susceptible to short-term volatility due to factors that stocks can overvalue or undervalue, such as liquidity, sectors, and equity preferences. Good stocks that can be affected by many other, short-term, factors over the long term will generate above-average returns. Long-term investors, particularly those investing in diversified portfolios, can withdraw from the market without materially affecting their ability to achieve their objectives. 4. Make corrections. It is very likely that you can make stable long-term profits. In reality, your investment may be less profitable or you may make a lot of money in the short term. You can lose money in the short term, but it is possible to get good returns over a longer period of time with good quality stocks and a long-term investment outlook. There are always times when some stocks don't work, so getting out of your investment is a wise decision. A long-term outlook based on quality stocks makes it easy to make timely decisions about changes without the need for daily and short-term trading strategies that keep track of changing changes. 5. Reduces the time it takes to track inventory. Unlike day trading, which requires constant monitoring of stocks throughout the day to take advantage of daily volatility, long-term trading can be done effectively with a weekly monitoring system. This approach is often much less stressful than constantly monitoring prices on a daily basis. In general, investors who start early and stay in the market are much more likely to survive tough times and take advantage of times when the market recovers. 7 common mistakes with estate planning. Planning your property is not a fun task, but it is necessary so that you can effectively and successfully rely on all of your property on what you have left. With careful planning, heirs can avoid paying inheritance or federal taxes on your property. Additionally, well-planned real estate ownership can help prevent confusion among loved ones. Yet for all the benefits of estate planning, many people make so many mistakes in the process. The most common mistake in estate planning is that you don't have the time to do it. Just remember that you should take the time to plan at least the financial part of your property so that you can leave some security for your loved ones. The following 7 mistakes are often very difficult in the family after the death of a loved one. 1. Don't fall into the trap that estate planning is only for the rich. This is totally wrong. Planning your property is important because it is important for the owner to leave it behind. Many people are unaware that their property is as large as it actually is, especially if they do not consider ownership of their home. 2. Remember to update and revise your will at least every 2 years. Factors that can change beneficiary information include death, divorce, childbirth, and adoption. As your family structure changes, so do your assets and the people you choose to transfer them to. 3. Don't assume that the taxes paid on your property are set in stone. Talk to your financial planner about how your beneficiaries can avoid taxes on your property. There are several tax planning strategies that can help you minimize or avoid taxes. 4. All financial reports should be organized in a way that is easy to find. Make sure someone close to you has information on where to find documents to plan after your death. 5. Don't leave everything to your partner. If you leave all of your equity to your spouse, you are effectively missing out on some benefits. You can get an inheritance tax credit, but if your spouse is the sole beneficiary, you lose some of it. 6. Make sure your child is well planned. Many people spend a lot of time deciding what to do with their property and forget to assign custody to their children. There are many details to be observed in detention. 7. If you don't have a financial advisor, find one. Financial planners and consultants are well trained on these issues and can provide asset protection that goes far beyond the fees they charge. If you need help finding a suitable financial advisor, get a financial advisor report. The above errors are common when planning the property. Take the time to plan for your death, even if you think it will be years before it becomes a problem. The secret to successful real estate planning lies in preparation. Long-term future investments. If you are ready to invest in future events like retirement or college, you have several options. You don't have to invest in high-risk stocks or initiatives. You can invest your money very easily and very securely, which will bring you decent profits in the long run. Let's look at the bonds first. You can buy different types of bonds. Bonds are similar to certificates of deposit. However, the state does not issue bonds, but bonds. Depending on the type of bond you buy, your initial investment can double over time. Mutual funds are also relatively safe. Trusts exist when a group of investors invests money in buying stocks, bonds, or other investments. Fund managers usually determine how money is invested. All you need to do is find a reliable and qualified trusted broker who will put your money together with that of other clients. Mutual funds are a little riskier than bonds. Equities are another long-term investment vehicle. Shares are generally owned by the company in which you invest. When a company is financially successful, your stock price goes up. But if the company isn't doing well, your stock will go down. Of course, stocks are even riskier than mutual funds. Despite the increased risk, you can buy stock in a reputable company like G&E Electric and sleep at night knowing your money is relatively safe. It is important to conduct an investigation before investing in long-term profits. When buying stocks, you should choose a stock that has a good reputation. If you are looking for a trust to invest in, choose an established and proven broker. If you're not ready to take the risks associated with mutual funds and stocks, at least invest in government-guaranteed bonds. Is it time for a refinance? Refinancing is a question homeowners often ask themselves when living in their home. Refinancing is basically a mortgage used to repay an existing mortgage. This may seem odd at first glance, but it's important to understand that, when used correctly, it can result in significant cost savings for homeowners over the life of the loan. If there is overall savings potential, it may be time to think about refinancing. There are some situations that require refinancing. These situations include when homeowners' credit scores improve, when homeowners' finances improve, and when national interest rates fall. In this article, we'll look at each of these scenarios and explain why a refinance may be needed. When your credit rating improves. With so many mortgage options available today, even people with low creditworthiness can find lenders to help them realize their home buying dreams. However, people with poor credit conditions are more likely to be offered unfavorable credit terms such as high or floating interest rates than fixed interest rates. This is because lenders believe these homeowners are more at risk than others due to their poor creditworthiness. Fortunately, with bad credit, many credit mistakes can be corrected over time. Some financial weaknesses, such as bankruptcy, disappear after a few years, while other weaknesses, such as frequent late payments, maintain a cheaper debt repayment rate and demonstrate the ability to repay existing debts. If a homeowner's credit rating improves significantly, the homeowner should inquire about refinancing their current mortgage. All citizens are entitled to free annual credit reports from one of the 3 major credit bureaus. Homeowners should use these 3 reports to check their creditworthiness each year to see if their credit history has increased significantly. If they see a significant increase, they should consider contacting the lender to determine the rates and terms they want to offer. When the financial situation changes. Changes in the financial situation of homeowners may also warrant a review of the refinancing process. Homeowners can earn a lot more from changing jobs and a lot less from vacations and job changes. Homeowners should definitely consider refinancing. Homeowners may find that higher wages allow them to get lower interest rates. Alternatively, homeowners who lose their jobs or receive pay cuts due to a job change may consider refinancing or debt consolidation. This can result in the homeowner paying more as some debts are paid off over a long period of time, but the homeowner's monthly payments can be less than their lifetime. When interest rates go down. Low interest rates are the only sign that many homeowners are rushing to lenders to discuss refinancing their homes. Low interest rates are certainly attractive because they can translate into overall savings over the life of the loan, but homeowners also need to understand that a home refinance is not guaranteed for every drop in interest rates. One caveat with refinancing to use low interest rates is that homeowners need to study the situation carefully so that the final cost of the refinance does not exceed the total savings from receiving low interest rates. This is important because if the refinancing costs are higher than the interest savings, the homeowner will not benefit from the refinancing and may even lose money in the process. The calculations for determining actual savings aren't too difficult, but homeowners can make mistakes with these calculations. Fortunately, there is a calculator online that homeowners can use to determine if refinancing is worthwhile. Is it always worth refinancing? This is a very important question that every homeowner must ask themselves both at the beginning and at the end of the refinancing process. The answer to this question encourages homeowners to move on to more refinancing questions or suggests refinancing ideas for now and persuades homeowners to focus on other aspects of the home. Set financial goals. This should be the first step in determining the appropriateness of the refinance. Without this step, homeowners may not fully understand their financial goals and may not be able to accurately answer the question of whether a refinance is appropriate. Financial goals vary from one extreme to another, but the simpler question is whether long-term savings or monthly increases in cash flow are more important goals. This is important because refinancing usually achieves both of these goals. Do you want to save in the long term? Homeowners looking to save money over the long term should consider refinancing options such as low interest rates and shorter loan terms. Both options can significantly reduce the interest the homeowner pays on the loan. This is important because less interest leads to more savings. Consider an example where a homeowner's existing debt is $100,000, the interest rate is 6.25%, and the repayment term is 30 years. Homeowners can significantly reduce interest payments over the life of a loan simply by shortening the loan term to 15 years. However, using this option also increases the homeowner's monthly payments. Consequently, this type of refinancing is only available to those who have sufficient liquidity to offset the increase in monthly payments. Would you like to increase your monthly cash flow? Some homeowners may have a specific goal of increasing their monthly cash flow. For these homeowners, the overall cost savings may not be as important as making more money each month. These homeowners are encouraged to consider refinancing options that can extend the life of the loan. This means that they will pay off their existing debts for a longer period of time. Homeowners will pay more interest over the long term, but will meet their goal of reducing monthly payments and increasing cash flow. How does refinancing affect tax credits? This is another important consideration for homeowners interested in refinancing. Mortgage interest is often tax deductible. A homeowner's low-interest annual refinancing can negatively impact their tax strategy. The impact of this type of opportunity may be greater for homeowners who were previously just below the limit for significant tax cuts. A significant reduction in the amount of interest paid means a significant reduction in the withholding tax a homeowner can take. This reduced deduction could result in a completely different tax rate for the homeowner and cost the homeowner money. Apartment owners who are considering refinancing should therefore ask the tax authorities to determine the effects of the refinance on their tax return before making a decision. Refinancing for debt consolidation. Some homeowners choose to refinance their existing debts. This type of option allows homeowners to incorporate high-interest debt, such as credit card debt, into low-interest mortgages. Mortgage rates are traditionally much lower than credit cards. Deciding whether to refinance a debt consolidation can be a daunting task. This equation involves several complex factors, such as the amount of existing debt, interest rate differentials, and differences in the current financial condition of loans and homeowners. This article attempts to simplify this question by providing a definition of the features for debt consolidation and by answering two important questions homeowners should ask themselves before refinancing. These questions include whether debt consolidation will make the homeowner pay more in the long run and whether the homeowner's financial condition will improve if the homeowner refinances. What is debt consolidation? The term debt consolidation by itself is misleading and can be confusing. When homeowners refinance their homes for debt consolidation, they are not really debt consolidation in the truest sense of the word. By definition, integration means to connect or connect to form a system. However, this doesn't really happen with debt consolidation. Existing debts are effectively paid off through a debt consolidation loan. Total debt remains constant, but individual debts are repaid with a new loan. Before debt consolidation, homeowners could pay off their monthly debt with one or more credit card companies, car rental companies, student loans, or any number of other lenders, but now homeowners have a debt consolidation loan. This new loan is subject to applicable loan terms such as interest rate and term. As each of these loans has been fully repaid, the terms and conditions associated with the individual loans are no longer valid. Do you pay more in the long run? When considering a debt consolidation program, it is important to decide whether you need to reduce your monthly payments or increase your overall savings. Debt consolidation may result in lower monthly payments, but a lower interest rate mortgage to repay a higher interest rate loan does not necessarily represent overall cost savings. This is an important consideration as this is not always the case. This is because the interest rate itself does not determine the amount that must be paid as interest. The amount of debt and the term of the loan or the term of the loan also play an important role in the equation. For example, consider a debt with a relatively short loan term of 5 years and an interest rate slightly above the rate associated with the debt consolidation loan. In this case, if the debt consolidation loan has a duration of 30 years, the original 30-year loan will be repaid at a slightly lower rate than the original one. In that case, of course, the homeowner could pay more. However, the monthly payments can be significantly reduced. With this type of solution, homeowners have to decide which one is more important: total savings or reduced monthly payments. Will refinancing improve your financial situation? Homeowners considering refinancing to consolidate their debt should carefully consider whether refinancing will improve their financial situation. This is important as some homeowners may choose to refinance due to the increased monthly cash flow, even if it does not translate into overall cost savings. There are many mortgage calculators available online that can be used to determine monthly cash flow growth, for example. Using these calculators and consulting with industry experts can help homeowners make informed decisions. Chapter 12, Real Estate Investing. At the time of this first publication, June 2022, the Fed is on the path of raising interest rates. Housing bubbles are starting to cool and prices will be pulling back. Some areas will likely see significant reductions in market price. If you have equity in a home, first determine if you are intending to continue living in the same home, regardless of what the market does. Obviously, there are cases of homes being in the same family for generations. If it's your home and you intend to stay in it, then don't look at it as an investment property. Real estate cycles will come and go. Another option to take your equity out of a home you live in is to do a sale-leaseback, where you sell the house and rent it back from the buyer. If you do sell your home to preserve the gains in equity, then you can always rent, while the market pulls back. Actually, as housing prices decline, so will rental rates, over time. Then you can repurchase a home when the market appears to have bottomed and get much more house for your money. However, if you do see your house as one of your investments or if you own rental property, then the links provided below can help you stay on top of the current market conditions. The Fed rate hikes and other political and economic factors are expected to cool the property markets. Some analysts predict a major decline in real property values in the United States. Thus, if you're sitting on some nice capital gains on a property and you want to preserve them, this may be the right time to sell. Then take the equity that you have protected. At buyandsellgoldbullion.com we provide resources and links where you can move money in and out of precious metals 24 hours a day and have your metals stored in an allocated account, in offshore vaults, or you can take physical possession and bury metals in your backyard, if that's what you decide to do. Here are some resources to help you stay on top of what's happening in the real estate market in the US. Other countries will have their own statistical data that you can seek out online. https://www.bankrate.com/realestate/housing-market-chart/ https://www.census.gov/construction/nrc/index.html 5 tricks to make it big with real estate investing. Real estate investing is one of the most attractive ways of making good money, that is if you do it correct. Moreover, real estate investing is also a lot of fun. A lot of people practice real estate investing as their core profession and, in fact, make a lot of money that way. Real estate investing is really an art and, like any art, it takes time to master the art of real estate investing. The key, of course, is to buy at a lower price and sell at higher price and make a profit even after paying all the costs involved in the two, buy/sell, transactions. Generally, people are of the opinion that real estate investing makes sense only when the rates are on the rise. However, real estate investing for profits is possible just about any time, and as I just said, real estate investing is an art. Here is a list of tricks that can make real estate investing profitable for you. 1. Look for public auctions, divorce settlements and foreclosures, bank/FHA/VA. Since quick settlement is the preference here, and not price, you might get a property at a price that is much lower than the prevailing market rate. You can then make arrangements to sell it at the market rate over a short period of time. However, make sure that the property is worth the price you are paying. 2. Looking for old listings. The old listings that are still unsold may provide you with good real estate investing opportunities. Just get hold of an old newspaper and call up the sellers. They might have given up hope of selling that property at all, and with a bit of negotiation you can get the property for a real low price. 3. The hidden treasure. A really old and dirty looking house may scare off buyers. But this might be your chance for real estate investing that can yield good profits. So, explore such properties and check if spending a bit on them can make them shine. You can get these at very low prices and make a big profit in a short time. 4. Team up with attorneys. There are a number of attorneys who handle property sales on behalf of sellers or in special circumstances, like the death of the property owner. They might sometimes be looking to dispose off the property rather quickly and hence at a low price. Be the first one to grab such real estate investing opportunities and enjoy the profits. 5. Keep tab on the newspaper announcements. Property sell-offs due to deaths, divorce settlements, immediate cash requirements and other reasons are frequently announced in local papers. Keep track of such real estate investing avenues. 4 Steps to success in real estate investing. Real estate investments are always good and sometimes popular. When it's hot, dozens of real estate seminars are held across the country. And thousands of people spend thousands of dollars on investments in education. It was surprising to find that thousands of people interested in attending these seminars, only 5% bought a home as an investment. Real estate professionals sell pipelines and easily profit from real estate. The truth is simple but not easy. This is a quick plan where anyone can start building their financial independence. There are 4 steps to investing in a private home. Buying a home below the full market price. Yes, people are selling their homes for less than the real price of the home. The key is to understand that most homeowners will only consider purchase offers that pay in cash and are between 5% and 10% of the asking price. Successful investors learn to find homeowners in financial distress who have no choice but to sell them below the market price. You lost your job or suddenly moved. You are divorced, they live beyond their abilities. This family was inundated with medical bills. And today their money is barely used to support drug addiction. Here is an example of a motivated salesperson. You have to sell and receive something other than the traditional amount. 2. How do you find motivated salespeople? You're working on it. Like any other business, developing a small marketing plan is essential. The simple but very effective method was demonstrated by Fuller Brush 75 years ago: door-to-door sales. You are selling your buying skills to people who want to sell. They are always ready when they need you. And you have the opportunity to help them with at least some problems. Door-to-door searches can find more information and purchase a home than any other method. However, most people don't come home 3 to 4 hours a week. Okay, there are other options too. You can view the foreclosure notices. Meeting homeowners soon after learning they are losing their home can help you negotiate with highly motivated sellers. Other public announcements that offer purchase opportunities include inheritance, divorce, and bankruptcy. You can follow the sales offers in local newspapers or on their website. You can include their names listed in these materials or send them a postcard in the blink of an eye to show their interest in buying their property. There will be an opportunity to buy things, but not a personal relationship. Once you have found a motivated seller, you need to understand how to close a sale that will benefit both you and the owner. A good real estate investor soon realizes that this is not a real estate theft. It is a solution in the best interest of the seller. By any means, homeowners can be protected from public humiliation. And in most cases at least give him some money so he can start all over again. No investor can deposit cash in any transaction. Nobody except Bill Gates had a lot of money. You have to use creative gimmicks like leasing, options, and mortgage payments. These transactions require little cash. You can find many inexpensive educational materials on these topics in bookstores or on eBay. The same training courses that sell for thousands of dollars in seminars. 4. Earnings when you shop. Don't shop until you know how to make a profit. If you keep it as a long-term investment, will my monthly rental income fully cover the monthly home loan payments? Will you sell your business to other investors for quick money? Do you want to renovate and sell your property at full price? Will you quickly replace it with more desirable features? Plan before buying. You have 4 steps that even a part-time investor can take in 3 to 4 hours a week. What ingredient is missing? Your determination and perseverance. If you have been following your plan for several months, prove that you are on the path to financial freedom. 5 things you should know before buying a property. 1. Money comes from buying, not selling sandals. When you build a house, your money comes from buying, not selling. People often buy houses with the intention of making huge profits. But I found that after all the renovations they can't make money. Because the house was bought too much. When buying property you need to make sure you buy enough home to repair, pay for shipping, and add about $6,000. The price is now $147,000 and if all goes to plan, you get less than $10,000. 2. Appreciate your home, fully appreciate your property. By spending a few $100s on these expenses, you can avoid many problems that you cannot see, things, pests, rotten trees, etc. after a thorough inspection. You can be sure you know something is wrong with your property before it's too late. When contacting home, make sure you have 7 days to complete the review. Don't do the job alone, find a contractor or subcontractor and get the job done quickly. You need to prepare your home as quickly as possible so that it can be renovated and sold. When I start looking in the mirror, my brother and I built a house together. And we help each other build everything. I have experience in building and I think it will save thousands of people. But it took the contractor more than 4 months to complete the job within a month. But let's try to save. We do all the work in our free time and after work. Which takes too long. For the second tip, we hired contractors for almost everything and built a new house in just 3 weeks with a new roof, new air conditioning, new wood, etc. We didn't spend all of our time working on the property. And we can use that time to find more deals. Here's how to get rich with real estate. Put a property between 1 and 2% of the market value, if you want to create properties and make money. The goal is to buy and sell properties as quickly as possible so that you can move into your next house and trying to sell it at the highest price to make a few $1,000s on your gloves and end up keeping it for 6 months is losing money. Sell your home at unbeatable prices and sell it across America regardless of market conditions. We were told there were no properties for sale in this market, but we went ahead and turned our house upside down. After 3 weeks in the market, we have 3 people wanting to buy a house. Because we offer so cheap that people want to skip. Here's what you need to do. Especially when the market is stagnant. 5. Hire a real estate agent. Don't try to sell your home. Take advantage of real estate agent skills and MLS system capabilities when you do an FSBO. Trust the people who walk by your home to see your signature. With real estate agents you have someone who sells your home for sale. This will give you more time to find other great offers if you want to help with the process. I've found that Craigslist and the Google AdWords homepage can help, but I use these tools with agents to secure the basics. Covered. Hope this article helps with some basic house building needs. If you study you will earn money. However, before you buy a house, do your homework and make sure you get the benefits of your business. 5 tips for buying a house. Buying a home should be one of the highlights of your life. Investing in buying a home is high risk. You should have some guidelines to help you decide which home is best for you. Here are some. 1. Determine your rights. When you are ready to buy a home, remember to understand your rights as a home buyer. If you know the home buying process, don't be fooled. You can do your homework yourself or find someone with knowledge such as a real estate agent or broker. Make sure the agent you hire is licensed and has extensive knowledge of the region. 2. Make sure you can afford it. When buying a home, your budget is the key. What you want is different from what you want. So keep it real. You don't really need a big house. If you're the only one who travels every day, right? Make sure you earn as much as possible. Ask for help or advice, especially those who know the price of the property. If you can't stay a year, buying a house is not for you. You can save a lot on a quick sale. 3. Make sure it fits your lifestyle. Make your home a home. Make sure it truly fits your lifestyle and comfortable for you. A good example of this is if you work in the office, you can find a good location near your office. If you like outdoor activities, you can find a good place to stay. Out of town with fresh air near the park overlooking the mountains or the beach. Your personality is very important in finding a good home. Check out the suburbs first and try to gather information about the area and surrounding area. Try to take into consideration the nature of your neighbors. 4. Consider your plans for the future. If you just got married, think about how many children you want. You can guess how many rooms or living space you need. If you can afford to buy a house near a good school, even better. School districts are more important to home buyers, which increases the value of your property. 5. Be organized. It is very important that your document files are clean and safe, because it will prove that the house is yours. This will help you a lot, especially when it comes to home payments, taxes and deductions. 5 basic rules for a successful home purchase. There are few purchases in life that can bear the economic and mental burden of buying a home. Whether you are buying your first home, move into your dream home, or limit your home and life after your child dies, it is important to understand the ground rules for buying a successful home. The wrong decision to purchase an apartment can have serious and long-term consequences. While making a smart decision to purchase an apartment can greatly increase the overall investment value. Discover the world of home buying and mortgages before you start buying your dream home. Although there are many websites designed to help entrepreneurs who want to learn all they can. But most financial experts say there is no substitute for good individual training. Fortunately, most mortgage lenders, home inspectors, and real estate agents can offer individual training. When buying a house, it is often better to systematize the system. This is because it is often the best way to ensure that all decisions are based on information and reason. It is not motivation or emotion. Buying a home can be an emotional process. But staying emotional and undisturbed by your judgment is important. There are 5 basic rules for buying a home or smart home. Number 1. Get financing before owning a home. There are some frustrating things in life, like losing your dream home because you can't afford it. Even if the desire for a beautiful home is understandable. But it's important to find the financing you need before you start buying a home. Advance financing has several important benefits. This includes knowing how much to buy and having more respect for the brokerage. Know how many homes you can afford before going shopping. You won't have to waste time looking for affordable properties. And the agents are more than willing to showcase homes in your price range. It is important to consider the different types of mortgages in the market closely before starting to buy a house. Today, there are more mortgage options available than the normal 15 or 30. For this reason, potential homebuyers need to understand how each type of mortgage works and evaluate which one is best for their needs. Number 2. Look at the community, not just the house. You should look at the whole community and not focus on one house. This is especially important for those moving to a new metropolis. Because those shoppers are unaware of the local climate and lifestyle. It is important to identify the areas most needed and to consider factors such as distance from work and local businesses. We have all heard that location is the most important criterion in real estate. And of course it is. Buying a home in the wrong area can be a big mistake. And the choice of both the location and the house is important. Only by sightseeing and talking to other residents can potential buyers learn a lot about the different parts of the city. Number 3. Be honest with your first offer. Attempting to insult the salesperson in the first sentence can be as disastrous as paying too much. It is important to thoroughly evaluate the local market and compare the asking price of the house with similar homes sold in the neighborhood. Similar comparisons for home sales known in the industry as complex. It is one of the best ways to determine what is right and to ensure that you are not overbidding or underestimating the property. Number 4. Always do home checks. Always inspect the home for potential deficiencies before applying. Compared to the price of a typical apartment, the price of a high-quality home inspection is negligible. So be sure to inspect your home before buying. Word of mouth is recommended to find the best home inspector. Why many of the best home inspectors people rely on word of mouth. Number 5. Don't drive salespeople home. Many real estate transactions fail due to the personal hostility of buyers and sellers. It is important not to alienate the home seller during the process and not to overlook every little detail during the sale. Maintaining the seller's goodwill will help the transaction go smoothly and provide the best deal for both the seller and the buyer. 5 tips to save when you sell your home. Your home is arguably the greatest asset for most of us and will be worth thousands in sales. You can use the money-saving tips in this article to cut down on shipping costs. Broker fees vary. So shop nearby and be sure to bargain and buy back with each other. You should aim for a 1% commission, so it should be enough to get through the commitment period of up to 6 weeks. It's time to sell the house. Switch to another broker without using multiple agents, which increase the commission by more than 3%, nothing to do. Make sure you get a fair appraisal and don't tell real estate agents rather than agencies. How do you rate your home? They will use it to modify the offer. This often leads to great prejudice. Choosing the cheapest lawyer is a false economy. Get advice from every real estate agent you talk to and get a personalized name. Not just a law firm. Do you call them and ask about pricing and make sure they are friendly, helpful, and most importantly, efficient? Negotiable price, excellent value for money. Play with each other to get the best service at the best price. You can save thousands by selling privately. 1 in 20 salespeople choose custom solutions that can save thousands. This is a great saving tip. But there are some downsides to. You can actually run ads in newspapers, flyers, and banners. Newspapers tend to charge a fee per line or word, so try to keep your ad as short as possible without making it relevant. The easiest way to sell your home is through one of the many home sales services available online. Of course, it's best to sell your home during a strong market and strong demand. So watch out for the local real estate market. The market is generally stronger in early and late summer than anywhere else in the year. Try selling your home if the for sale sign is already in your way. It is better to wait a moment. Studies have shown that unlisted homes can take longer to sell. And the price will drop by thousands, so throw the brush away and paint your house with new paint. And do all the flashy work with your own hands. Talk to your real estate agent to increase the value of your property. It may be worth investing a little money to earn more, but be careful not to spend too much. You may not get your money back, so discuss any planned improvements with your real estate agent. If you commit to saving money by selling your home, do more research because knowledge is power. Sites like MaxSave specialize in giving you money-saving tips. A quick look at these pages will help you get all the information you need and save a lot of money. 5 tips to add value to your home when you sell your home. 1. Do your homework first. Find out about market conditions in your area. Sales will be better, worse. Depending on the area when you decide to sell, there are 3 levels of services to consider. Sell your home, FSBO. Sign up with your regular discount, broker payment. Take advantage of a full-service real estate agent, broker. If you want to sell a house, keep in mind that you are responsible for marketing your property, as well as all legal information, reviews, ratings and more. You must be aware of the ownership documents and the legal implications of the transaction. You can also hire a fixed or discounted rate agent to help you sell your property. Depending on the broker you choose, you may be able to get help from the market, open houses, check status, location, loyalty, and more. Make sure you know how much you want to pay. Make sure you understand which services are included in each plan. Find out if your ad will appear on the site. What fonts can you use? Find out if you are promoting your apartment with the right MLS service in your area. Each broker is different, so make sure you get feedback from previous customers. If you want to sell your property to as many buyers as possible, advertise your property with a full-service real estate agent, broker. Find out if you are a broker, member of the National Association of Realtors, a commercial organization with nearly 1 million members nationwide. NAR members adhere to a strict code of conduct to ensure the highest levels of service and integrity. You may also want to know if they have realtor roles such as GRI and CRS that require additional real estate training. In addition to the skills, be sure to check the broker's recommendations. Talk to existing customers to see if they have an agent. To inform you of progress, contact your representative directly to give you complete peace of mind. Agents working with your ads must. A detailed marketing plan for your home, including online and offline marketing. Run a comparative market analysis, CMA, on the properties for sale and the listing in your area. Help us find the best selling price for your home. Suggestions for improvement. While your home is on the market, a potential customer will make an appointment to view your home, including opening days for you or your broker. Try to rate the house as if you have seen it for the first time. Buyers must imagine living in their own homes, so make sure the property is in the best light. Put yourself in the potential client's shoes, look at the property from the front and highlight the cheapest additions. 2. Clean as much as possible. You should paint the walls, neutral colors are best, or seasonal wallpaper. Replace old damaged floors and carpets. Inspect and repair damaged or ugly seals in bathtubs and showers. Order a cleaning service if possible. Show off the best linens, towels and shower curtains. Cover the beds and arrange the fresh flowers on the table. Make sure there are no unpleasant odors in the house. The smell is the first thing shoppers notice, and it tends to deodorize all the time. 3. Make your home your new home. Store or pack small appliances and other items, which can be placed on pallets or tables throughout the home. You want shoppers to organize space in each room. Therefore, it is best to bring small items out as much as possible. Delete personal belongings, photos and objects. For accurate display, bookcase and walls. Rearrange furniture to make the room more spacious. Replace dense curtains with translucent curtains that let in more light. The bathroom is clean and tidy. If necessary, keep the cassette in a remote place. You can also rent temporary warehouses to free up every part of the house. 4. Make sure you get out. Proper landscaping will make your home more pleasant. Turnip, bald, liquid fertilizer. Look closely at bushes. Shrubs with closed windows should be trimmed to allow sunlight and light to enter the home. Fill the bald spot with a small shrub in years of vigorous growth, for example, touches and petunias. A few flower pots on the front door can be very attractive. Today's buyers want low cost of ownership. Your goal should be a well-kept, easy-to-maintain garden. 5. Allow your agent to inspect your home. The buyer was reluctant to hurt the current owner. Therefore, they may be denied the choice of house if you attend an open house event. Flexibility with your demo fast home shows are always annoying right now. But the more you see your home, the more likely you are to find a seller. 5 characteristics to consider when choosing a real estate rental service. If you are thinking of renting a house or apartment in Spain for the holidays, there are some key features to consider beforehand. You want the best service and at the same time the maximum profit for your vacation rental. Here are 5 key features that every real estate rental service should have. 1. Excellent customer service. Your guests will recognize you by the service they will receive during their stay in your villa, apartment or holiday apartment. The property rental service you choose should provide excellent customer service and advice from a satisfied owner. Your guests will need to go to a clean villa, house or apartment. When renting a holiday, golf or any other holiday in Spain, all guests are encouraged to receive a welcome pack with directions to the rental location and useful information about the area. When you have an apartment for rent, tenants must be treated well. Reception, maintenance and assistance in setting up local services and telephones must be done in a courteous and complete manner. 2. Cleaning management. Rental services require reliable cleaning arrangements. You may be too far away to clean or maintain the house. If you live in the UK or the US, but if your flat is in Fuengirola, Mijas, Puerto Banús or Alveria in Spain, you need a property rental service that is thoroughly clean. For apartments and villas, cleaning will be required between each guest and sometimes during the week of stay. In the villas, the lawn must also be taken care of. Make sure it's included in your service. 3. Key for keeping inventory and requirements. You may not be able to run local errands for your home or condo. Therefore, these tasks should be entrusted to real estate rental services. Requirements for maintaining the legal operation of a rental property include central ownership, insurance, property and liability taxes, building permit or permit, bank account management, installation and telephone support, etc. Another important area is the inventory. Furniture and other valuables inventory documents should be kept in your home or villa. And physically check every time a guest leaves, of course if you live in another country. But there are apartments for rent in Spanish areas such as Costa del Sol, Marbella, Benalmádena or other areas. You need someone on the website who can check your inventory for you. Choose a real estate rental service that offers these services to help you manage your absence. 4. Major building improvements and repairs. Another feature to watch out for when renting a property is whether renovations are available. This is an advantage that suppliers already have contacts to do the necessary work. You don't have to spend hours looking for a trusted contractor or mechanic. 5. Promotion of your apartment or holiday home in Spain. Make sure the rental service advertises your apartment for rent or for rent in Spain. The promotion increases rent and profit every year. Property rental services can process your listings in local, national and international regions. If they have a website, they can advertise your rental property. If you have a rental property near a golf course, don't forget to advertise your accommodation as a golf vacation. Keep these characteristics in mind when looking for real estate rental services. If you choose a service with great features, you will be sure that your vacation or your home will be in good hands. 5 key factors successful vacation rental owners often use. When you spend money promoting your vacation rental on a vacation rental website, you need to be sure that real estate will be successful. Here are 6 things you can practice to get the most out of your money. Get your home price correct. If you want your vacation to be rented, you have to be true, be optimistic, but not greedy. Set the actual rental rate for your property. And make sure the prices on your listing page are correct and check regularly when the market changes. Look for similar articles, comps, in the same place as yours. Only charge a premium if your property has certain special features. And ready to reduce the price of your property if necessary. If you lose money from weekly rentals in this business, you can't compensate. 2. Check your email regularly. When you use a hosting site like https://www.verbo.com, keep in mind your users, they are often internet savvy and often check their email, especially after asking for information. Call directly from time to time, so be sure to check your phone messages. 3. Respond promptly. Vacationers often see the property they are interested in and contact the owner himself. Faster you answer, your chances of winning will be greater. In most cases, there have been many times that I have rented properties in the past, and since the owner took 24 hours to respond, so I chose another property. A timely and effective response will convince the tenant that he will respect the lease. 4. Your offer must be accurate and complete. Make sure the information on your offer is up to date and complete. Check your online listings regularly to make sure your contact information is up to date. Also, make sure your property and furniture details are correct. This will help you have loyal customers and problems with your lease or related laws. 5. Big picture. As the saying goes, a picture is worth 1,000 words. Remember, renters, usually, consider living on your property based solely on your photos and words. The more images help you make up your mind, the better. That's how I saw it. If you are buying a used car, you will do it online without having to look closely at the exterior, interior of your car, engine, etc. Not all is the same. But you have an idea. More photos, more beautiful. Make sure you have photos of the equipment you are renting, such as the ones you are renting. Be view of the pool, beach, mountain, lake or golf course. This is the best-selling holiday apartment. End notes. Hopefully you have found this book to be useful and informative. Please feel free to leave feedback at any of your favorite online booksellers. Perhaps, there are people you know that would also benefit from this information. Take a moment to share a link with them at your earliest convenience. We are in volatile times and you may be doing them a great favor. Please visit blog site and join our list. You can find much additional information and resources on our blogs at buyandsellgoldbullion.com.